No news, light volume. It's Tuesday, June 10th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, as we're here to take you through the rest of this trading hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, if you're here on the website, tastylive.com, thank you for joining us. If you're over on YouTube, or come over to YouTube, tell us what you're trading, what you think of this action. As Victor might say, smash the like, spoof the algo, whatever you got to do to get more audience here is apparently the edict. So we are here to talk markets, guys, and it's a day where it's pretty quiet out there. We only crossed 1 million contracts traded here in ES by the end of the session, barely 1.01 million contracts traded. It is a slight gain of 0.5% here in the NASDAQ, a little bit more than that actually, 0.57%. Weakish, sloppy 3-year note auction doesn't really do much for the bond market. Bonds inch up across the curve, but not by much. Gold and silver take a step back, as our notable metals bear Radigan points out at the end of last call. Dump the metals apparently as a theme for today, although not terribly. We see that oil reverses here after being higher over the course of the session, does come back in. And likewise, that dollar, it is a touch firmer here on the day. Tomorrow we have the inflation report due out. Maybe that's what this market's waiting for, or more signs from the U.S.-China trade talks in London, which are still ongoing. They have resumed those talks after dinner. So we have a lot to discuss here today. Dylan, you are apparently a bull's bull again. Welcome. 60-45 here. Yes.
I call this the full bull.
What makes you the full bull here? And what has changed your mind?
I believe all of the Trumpian fears, whether it's the legislation or the tariffs, is irrelevant and unlikely to occur. I think all the social stuff is a distraction, and I believe that Trump is actually rapidly becoming a very weak president. And I believe that not only is AI more powerful than anybody can comprehend, but I also believe transportation technology is more powerful than anybody can comprehend. And I believe that the overall economy is shockingly resilient relative to all sorts of adversity. Makes me want to own the bond, which I bought today. Makes me want to be short gold and silver, which I did today. And makes me want to be long the dollar, which I did today. I was more active today than I've been in some time, and I'm full bull. And that's all that's all I have to say for myself.
By the way, if you want a wonderful contrarian indicator to support Dylan's case, the fact that these protests in LA are burning Waymos is a great statement as to the wonderful future of transportation technology.
Yeah, there you go.
If you wanted the Economist cover level indicator for here is a company that's going to do well and here's a sector that's going to do well, that nutcases are burning Waymos, very encouraging.
And everybody's so jacked up on AI that no one's talking about transportation tech at the same level. I believe that the transportation technology discussion should be as fervent and insane as the AI conversation already is and has been for a couple years now anyway. And I think that it's underestimated in terms of its impact, in terms of the velocity of the economy. And I just think it's another huge tech vertical that is underrepresented. And it's one thing to have one pillar of glory with AI, but if you add a second pillar of glory and you add a rapidly weakening president who's going to have a hell of a time implementing any policy very quickly here, I love the dollar. I like the bond, and I think metals are overvalued.
Ilya, you know what?
Kind of a testament to what we talked about yesterday. This idea that there's loud gridlock afoot. And even though it's loud,
more and more room for it.
Yeah, that even though it's loud, the markets do like gridlock.
What's really interesting about what's happening in California, just from like an anecdata perspective, and talking to even political-minded folk, like, oh, what do you see the protests? You see what's going on? Marines being deployed.
Yeah.
I would say 4 out of 5 times I've had that conversation in the past few days, the first remark is, we have self-driving cars.
It's a symbol. It's become a symbol.
Well, no, but it's kind of
that's really important.
I think it's kind of I mean, we're all online. Like, we're all on Reddit. You're on Twitter. Like, where are you seeing the technological edge discussed amongst people? GitHub, right? Like, where new code being posted, right? Like, we're in the thick of it. So when AI comes out and there's a new Chat GPT model, we're talking about it because it's the most liked thing in our feeds because Sam Altman or, the OpenAI account puts something out. But for the regular person, we're talking about Tesla cabs and Optimus and, robots.
I mean, and Ilya sees it all the time in San Francisco. I go to California, 3 or 4 times a year. If you haven't seen them, you don't understand, but they exist and they're everywhere. And
San Francisco is crawling
and Tesla's face deep in $1 bajillion million on this. Google's face deep in $1 bajillion million on this. The transportation, and it's not just the cab fleet or something. We're talking about transportation tech ranging from the entire logistics chain, even just the efficiency of how they pack trucks and how they position trucks and all the container ports and the port technology. Remember, we saw this whole thing with the ports with Biden. That's going to change. The ports will change in a way that is much more efficient and much more productive. And trucks, all these things, it's going to happen. And it's one of those things where nothing happens. But when it does happen, it happens so much faster. It doesn't happen incrementally. It's just, I love to tell this story, but when I was having been on the floor of the New York Stock Exchange for years prior to digital markets, basically, and then listening to the speeches to the floor trader, we're going to do this hybrid system, and it'll be a slow transition, and all the blah blah blah. And then the day finally came. I don't remember what year it was, but the day finally came where they flipped the switch, and I swear, I think that very first Monday morning, something like 80% of the volume traded off the floor immediately. And I just think that the same thing's going to happen with transportation tech in a way that is profound.
Ilya, it kind of surprised me. I was looking at this earlier. We have images of Waymos burning on the street, of course, which is most closely associated with Google here. Google, outside of, Google and Tesla are your top 2 performing Mag 7 names this week thus far. Social political commentary, aside from what's happening in Los Angeles, I'm kind of taken aback that some of the first reactions I'm hearing, and most of the time, right, I'm saying 4 out of 5 times, people are saying, wait, so these protesters, very dumb, obviously, you're getting on your phone where you have an account with your name and credit card attached to it to call a Waymo to a protest for you to burn? Come on, use your head, folks. But if that's what they're doing, hold on a second. You can call a self-driving car to come pick you up and take you anywhere.
What a demonstration of the technology, and what a demonstration of how in the zeitgeist Waymo is, that crazy people are attacking it.
I would argue more people became aware of self-driving cars over the last,
That's my
4
point.
days.
Yeah.
Than the totality of the incremental awareness that had been accrued over the last 5 years.
That's kind of what I'm getting at here, right? Looking for...
People hadn't seen it. Now they see it.
All right, so we're always trying to find silver linings in dark clouds. Perhaps an interesting...
The rest of us are trying to find dark linings in silver clouds, but go on.
There's plenty of dark linings for you here. What's interesting about the iDrive ETF, this isn't like a typical, you'd have to break this down, but the iDrive ETF has BYD in it. It has a lot of Chinese names in it. It's Rivian, there's Porsche, there's Renault, there's Volkswagen, and it's been basing for a long time here. And there's just this little voice in the back of my head saying, if we're going to see this in the news all the time, maybe we should be considering the fact that this seems to be a pretty darn good advertisement for the self-driving vehicle class. Aptiv, which is another company that works in the space, which would be in the iDrive ETF, 4.75% higher today on the back of all this. We could head over to a name like Rivian. It's bounced a little bit this week. We can go over to something like Renault. The performance has been mixed here, depending upon, actually, that's not going to load, depending upon where you look. We're not going to get these tickers. We're not going to get these tickers. Well, the point is, let's just look at the broader ETF. We're approaching the top side of the yearly range, and we spend so much time talking about AI around here that self-driving vehicles have been overlooked, and it feels like a bubble was just popped. in the past few sessions in terms of breaching the public zeitgeist. The iDrive ETF is up 2.94% this week for what it's worth. SPY is up 0.66%. Triple Qs are up 0.81%. Semiconductors up 3.7%. So like not many things are outperforming it right now in the broader market. And I don't know. It feels like an interesting way to discuss what's happening here. It feels like there's new technology being showcased that a lot of America hasn't been exposed to yet, even if they've heard about it perhaps in a tweet or a Wired.com article, which most Americans probably aren't reading. Dylan.
And I believe, and Elon's return to Tesla, despite all of the awful things and all of the terrible things and all the screwed up things, he was going to return with a vengeance. And the first threshold of excess performance is a fleet of self-driving cars that will lay up, and for that matter, self-driving trucks. I'm talking big trucks that can do coast to coast. And anyway, yes, I like the sector as an investment for the reasons we're describing, but also I believe it's a pillar of economic activity that is underestimated right now in a world that's obsessed with what they perceive to be the sort of the AI core. Of all the names that we know. I won't repeat all the AI names, but I just think that people are underestimating how powerful and significant this is, and I think that the burning of the Waymos is the best thing that ever happened to them.
Ilya, if only to put like a finer point on that, I would pull up the Google Trends chart here for self-driving car. And right now, according to this, over the past year, we're looking back, we have hit what would be considered the 100th percentile on the search term over the past year. So like this is why this intrigues me. I was going through this exercise actually with Jamal today about the word tariff. The word tariff in search terms is in the 5th percentile over the past 90 days. And in news terms, it's in the 7th percentile over the past 90 days. It's basically a non-factor in people's attention right now. But then you swing over and I start looking at some of the keywords in the news recently, and I go, self-driving cars are being picked up a lot. And I've heard this own feedback in my own personal life. Like, did you know that there were self-driving cars? Like, yeah, you didn't? No, I had no idea. Oh, okay. Well, sure enough, the interest is there, and there's a bunch of junk in some of these, in iDrive, but like a name like this, Gentex Core, what do? They make auto parts related to electric vehicles. They were up 2.87% today. A lot of weird things rallied today, even though it wasn't a significant move in this market, broadly speaking, the indexes. But there did seem to be a little bit of a theme here starting to emerge. And I think, Dylan, maybe this is a theme that we should be keeping an eye on moving forward. Just a different way of approaching the weekend's
The only
news.
question is how to, for me, it is without doubt or question. I think the only question is what mechanically is the most sort of prudent, risk-adjusted, non-madman's way, the prudent man's trade to get long something that's basically a certainty. It is. The self-driving cars are here. They're going to be everywhere. It's going to happen. The only thing that's discounting price at all is timing. And so it's just a matter of understanding the most prudent way to get long from a trading perspective, outside of just sticking the iDrive or one of these companies in your sort of investment portfolio and saving yourself the trouble.
Yeah, I mean that self-driving cars are a fait accompli is that. I mean that's there already. They're already so ubiquitous in the streets of San Francisco that it is just a matter of scale now. The fact that they are able to operate seamlessly in a city that's dense and full of traffic and full of people and buses and all manner of other things, because San Francisco is not LA. San Francisco is dense. That's already on display here, clearly. To do this to trucking would be easier because that's in many ways a straight line. To do this in other cities becomes a matter of scaling, but the proof of concept is obvious. The thing that interests me from a trading perspective versus an investment perspective is, do you buy this now with a 45 DPI DTE type of cycle in mind, or even longer. I've been doing 60 lately just to kind of keep my risk a little bit more contained in these choppy markets. But let's say even that. Is that a story for that kind of a cycle? Or to Dylan's point, is it a story for eventually this becomes a thing? You know that's going to happen. Stick it unlevered into a portfolio and forget about it for the next 10 years, other than buy more when there is a spot to do it. And if it's the latter view, then you probably wait to clear this most recent high, and then you just buy the ETF, call it a day. And the next time it dips, you do that again. If it's more the trading sort of view on this, then your risk reward is probably not ideal because you're near that high.
Mm-hmm.
And so then you're sort of waiting to see, do you break the high for a breakout trade? Do you get a pullback because of generalized risk aversion? Because let's say, and I'm not saying this is going to happen, but here's a sort of simple scenario. CPI comes out and there's a bunch of tariff-related inflation in it this time. It isn't hidden in the PPI numbers this time, as we found out for April. Once the PPI numbers came out, we saw, oh, CPI was refreshingly normal. And then we see the PPI numbers and go, oh, it's refreshingly normal because businesses ate the inflation and didn't pass it on to consumers. It's not like the inflation isn't there. It is. It just ended up being in businesses' margins. So let's say this time that doesn't happen. But as, let's say, the PMIs suggest. Let's say this time they passed it on. And you see it in the inflation numbers. And you see it in the inflation numbers despite the fact that the economy is slowing and the Fed wants nothing to do with a rate cut, at least until September. Okay, now what? You get generalized risk off, maybe, that sinks everything, regardless of sector, regardless of theme, regardless of whatever. And then maybe you get a better risk reward setup in these things as a trading vehicle. As an investment vehicle, if you want to not be time sensitive and not be tethered to options expiries and be unlevered and just stick it in a portfolio, I don't see why not.
Yeah, there's not many tradable liquid products within there. And if you're going away from the broader sector, you got to pick and choose winners, which I think is worth an exercise of reviewing. I'm personally going to be spending the time in that. I like to put together small thematic baskets that I trade and just put in my pocket. One of which is kind of working out, I guess, with a AI phase 2 basket that I've been tracking in this year since late January. I mean, it's up 2.9% year to date. 3.03% year to date, which is a little bit better than SPY's 2.9% year to date gain, but it's below the Nasdaq of 4.5%. So it could be a function of stock selection, not necessarily the theme being wrong. But I like thematic baskets, and I think it gives us something to talk about and follow. And more importantly, it's now in people's attention span, which not just anecdata, Google Trends. Highest interest that we've seen over the past year for self-driving cars and robotics, obviously. There's a guy named Brett Adcock on Twitter. He runs one of these robotics firms, and he posts videos of what his robots are doing all day long. Really fascinating stuff. So when Musk says that they're coming sooner than later, that's something I think we can believe in. But Dylan, you mentioned being a bull.
My only question, I know we've got to move on. We're sort of grinding on this, and I apologize. But my only question is, why wouldn't you just buy Tesla? Like, why overthink it?
It's a really good point. Mags are up at the, highest levels that we've seen since the February 21st growth scare.
Mm-hmm.
Yeah, just on price. I mean, Tesla's there driving this higher too. It had a big reversal intraday yesterday where it was down like 3-4% and closes 5% higher. Today it has now a 6% gain, basically 5.67%. In the bag, Ilya, I know that doesn't look like Trump and Musk are getting back together anytime soon, but Musk's feed, if you went into a coma on Thursday at 12:45 p.m. Eastern time, before Musk tweeted out such ingratitude at 12:46 p.m. Eastern time, and you woke up today and you only looked at the tweets from Sunday, Monday, Tuesday, You wouldn't know that Trump and Musk were on the outs.
Not necessarily, no. Of course, everybody is writing about it, but with the stuff going on in LA, it's already dropped out of the kind of big headlines, and you really wouldn't know. But again, for me,
so hold on a second. So the public perception is that Trump and Musk have a really big fight. The LA things start. Trump and Musk, if you're following it closely, seem to be making amends, but the broader public only knows about the fight and now about the riots. So the average person thinks that Trump and Musk are on the outs when they're really not.
I mean, well, whether that they are or they're not,
they're not on the outs.
The president doesn't seem to want to engage with anything, and Musk seems to have been talked down by cooler heads to say, look, you have a bunch of federal contracts. Don't bite the hand that feeds you quite so loudly.
And that doesn't come across as odd to you that both of these men are acting completely out of character? Right.
I mean, it strikes me that the president understands that he doesn't need to do anything for this to go away. And it strikes me that Elon Musk has been made to understand that he does not need to be screaming publicly right now. And that this does not benefit him for whatever future endeavor he wants to make into politics. That he basically needs to rebuild his war chest here. And he can't do that if he loses the money-making machine. So it seems like we have a kind of détente. And that's fine. For me, as far as sort of the logic to buy Tesla as a trade vehicle, it's the same story as you would see in NASDAQ, in S&P. We've backed up into the underside of the preceding range, so we're testing near-term resistance. Let's see a break. Or a pullback. Either or, by the way. You pull back to 300-ish, you've reset risk reward, it makes sense to go long. You break north of, let's call it 370, you've reset the range. You have clearance. For a trade, for an investment is a different conversation. For an investment, this is a big discount in Tesla. If you're going to own it for the next XYZ years, I don't see a reason not to buy it here. Certainly the Trump-Musk fight is not a reason not to buy Tesla.
No, not a reason not to buy Tesla. I again, one of those pieces of anecdata after the Trump-Musk fight this weekend, talking with people joking like, oh, it's safe to buy a Tesla again? Thank God.
Whoever was going to get a cheap Tesla while they were on the receiving end of the blowback, now apparently it's Waymo. Look, it's moved.
Well, until Tesla's self-driving cars are in Austin, but
now Waymo is going to have to put stickers on their thing saying we don't endorse XYZ, whatever.
Dylan, I mean, I think it's just right. I mean, Tesla's got robotics. It's got the AI. It's got the cars. Change happens faster than people appreciate, right? So
yeah, well, it's nothing, and then it's everything.
And it's everything.
Or at least
nothing matters until it all matters.
Yeah.
Well, I mean, we're reaching that tipping point. I think everyone can kind of feel that it's coming, and I know for people who are in like information services roles like we are, AI is something that's becoming an increasing part of our day-to-day, use. At least for me, it is. I use it every single day, professionally, personally, for various tasks and things. Some of it automated to do stuff for me, some of it to find information. But I think it's a way to augment, like for what we're doing, it helps augment and cut corners. You know how great it is to be able to feed, my little Chris GPT a spreadsheet and say, like, tell me what this says, as opposed to me having to, like, hell, even have to feed a bunch of things into Python or like our Jupyter platform here and run a bunch of code. I just give it a spreadsheet and go, tell me what this says. And it knows all the algos and the formulas and all the data analysis that I would do because I programmed it to do that. And it just saves me hours of time every single day. So I think that's where you have to use this in the world moving forward to augment whatever you're going to do, because the change is coming, and it seems to be coming pretty fast. It seems to be coming pretty fast here, folks. We're halfway through the show. Today was a pretty good rally. I know people like Goldman Sachs are out there saying that start selling the junk rally, although I would point out that this is a market here, in the short term, that is seeing increased breadth, the sort of broadening out right now of the rally. QQEW, equal weighted NASDAQ, is up by 0.79% today compared to the 0.66% gain for your market cap weighted NASDAQ. Same thing for the S&P 500, of course, up by 0.52% in RSP. We head over to SPY. It's slightly different. Actually, they flip now here, 0.55%. I stand corrected. Most of the session, the equal weights were leading the market cap weights. But you're seeing the equal weights, I suppose, which is the point of this. They're pushing to relative highs right now. RSP is getting up there. QQEW is starting to get up there. This is a market with broad participation. So, Ilya, I pose this to you as the bears bear around here. We have low volume. We have low volatility. We have a market that seems either very complacent or very confident that nothing will ever happen that's materially negative to the equity market outlook. We have a Fed meeting next week, expiration, June options expiry, of course, quarterly option expiry at the end of the month. We have the July deadline for these tariffs. How is a bear handling this right now? Like, how do you try to keep powder dry, or do you load the boat now saying it's as cheap as it can get to get bearish? I have to take a swing here because this thing is weaker than it looks.
I mean, I certainly am of the view that this thing is weaker than it looks, but then you have to approach that point of view tactically. I've been sitting on the short side in a risk-defined vertical in both the Qs and in SPY now for quite some time. In fact, I'll give you the exact dates. I've been sitting in the Qs now for about almost 40 odd days, and I still have tons of duration, tons of it. On some of the contracts, still 38 days worth. So for me, it's you take a stab, you take a risk-defined, extended duration stab in the ETFs, which are smaller than the futures, and you see, because you have to be really insulated against the market wanting to fight you. So for me, this isn't anything I have a tremendous amount of additional conviction in now versus when I put these things on. It is notable, I think, if you look at either ES or NQ, where we end up here today on the eve of CPI, and I think in ES is probably where it's most profound, because actually it made a better run through its near-term highs, arguably. It made a cleaner break.
Sure.
But look at the underside of the consolidation range before the holy hell begins in February. And look at just the open on that green abandoned bar right there at the bottom of the range. So the lowest open in that series. A little bit lower. Basically right, yeah, exactly, right there. You've closed on it. You've stopped directly on where the consolidation became a sell-off. So this is a very interesting spot. I'm perfectly happy, by the way, to let my puts expire worthless, because I structured them such that they could do that. That's sort of the benefit of cheaper vol and smaller size and long duration, to keep your loss small in the worst case scenario, because you're fighting a market that doesn't want to go your way. This is sort of the beauty of options. So we'll see. But for me, this hasn't sold me on the idea that the premise that brought this market down at the beginning of the year has changed, because it hasn't. The premise was slowing growth. And then that was hijacked by all kinds of noise. Well, we've gone through the full sentiment gamut on the noise. We went from, oh my God, the US-led financial order is being imploded from within, now to none of any of it matters. But at the end of the day, it's neither of those things. Of course it matters. And it matters not because we're going to implode the US-led financial system. It matters because businesses and consumers need a semblance of policy certainty to make decisions. And without it, there is not economic growth.
Dylan, can I challenge Ilya on some dark grounds?
Yes.
Be my guest.
What if the stock market's increasingly becoming a game that is increasingly detached from the real economy?
It's very possible.
Right?
It's very possible. We heard Moody's warn today of the...
Moody's. One of our prestigious rating agencies. Go on.
Yes. They warned today. This is how you know this is right on time. They warned today about money managers and institutions chasing retail speculation.
Yes. Well, they had to. Quarter's coming to an end soon.
Wow.
They sold out in early April.
Perfect.
Knew it was coming.
Perfect. It's perfect. Which tells you you've maybe reached maximum on the froth. And whether you have or not, who knows? You were mentioning, I think, right on time, that speculative short positioning in the latest cotton report has been nearly wiped out, and that's as of Tuesday of last week. Now, when we get the report this week, it'll be as of Tuesday this week, and looking at the markets here, chances are there isn't much short positioning left, which is a pretty good recipe for a rug pull. And for me, that rug pull is very simple. If the inflation data, both tomorrow and the PPI numbers thereafter, tell you that consumers aren't coming despite businesses having stocked up and spent all this money on extra inventory and eaten the extra price margins, then there is no way to avoid a recession, and the Fed doesn't care and won't care until it's so obvious to everybody, much as self-driving cars in San Francisco, that it's too late. And by then, markets will have anticipated already. And if you look at the break-evens in the bond market that are telling you that a recession is coming, which were moving in lockstep with the S&P from the beginning of the year until the bottom in April, and then pointedly decoupled, stocks rebounded, break-evens didn't. Break-evens are telling you you're no better off. That tells you stocks are frothy, probably, and driven by sentiment, probably, and decoupled from the economy, as you're saying, probably. With all of that, you're waiting for a breaking point. Does it come tomorrow? I don't know. But as long as I'm structuring my exposure in a way that's risk defined, where I can take a loss equivalent to this thing expiring worthless, and that doesn't debilitate the account, that isn't anything to look at other than, oh, well, that's a trade that didn't work. The short dollar trade did. La-di-da. On we go. Then I'm happy to sit in it. It comes down to risk management, ultimately.
So we have China trade talks perhaps guiding the market higher here today on some optimism. There was a rumor this morning that the trade talks ended early, but no, of course, just like what we heard in Geneva, that was actually fake news. They were ongoing and they were just taking a break for a meal because they're people and they need to eat.
Is it safe to just assume that whatever headline comes out, the opposite is true at this point?
Yeah, like they're not ending, like U.S.-China trade talks end at 1 p.m. exactly on the dot in London. Okay. And then they're back on an hour later after lunch. Got it. So that was the case again today. They ended, they took a break. They were meeting again after dinner. They're still going on right now. From my view, that's probably a good thing. The longer the talks go on, the more that they're discussing. They're going into the weeds. They're really, delving into the details. So that might be a buy the rumor, sell the news event this week. But before we get there, we don't know if that's going to come today, tomorrow. We know that Carolyn Leavitt, the White House press secretary, said the goal is to leave the meeting with a handshake agreement. So they're not there yet. Inflation data is due tomorrow morning. There's part of me that says this is important. It's inflation data. Inflation data always matters.
Yes.
There's another part of me says that this doesn't matter a lot. So, Dylan, I'm going to make the case that this doesn't matter. One of you two has to convince me otherwise. I'm going to go to the options pricing here first.
Start the clock. 60 seconds on the clock. Why the inflation data doesn't matter.
Fed's not priced for a cut next week. 3% chance. They're not priced remotely close for a cut in July. We're going to get a new summary of economic projections that, if we look to the inflation data that's here and coming down the pipeline, we're probably looking at a modest bump in headline inflation the next few months as we make our way through a base effect window. So inflation this week is expected to rise. We're going to look at from 2.3 to 2.5%. And the June tracking thus far through the Cleveland Fed is basically 2.7. So we're not going to get a cut. We know that. We're not going to get a hike either. We know that. The Fed's told us they're more concerned with growth. The market's only priced 43 points through the end of the day tomorrow. That's accounting for 3 as well through the end of this session. So 40 points, less than 1%. We're at 6,000 now. We're talking about 2/3 of 1%. That's a nothing day being priced in. It doesn't impact the Fed. I don't think we care. I don't think the market cares. I don't think we should care. A 0.2% month-over-month run rate is fully in line with the 2% year-over-year target. The Fed is not going to blink, neither should we.
Shall I?
Go for it.
Well, hang on. Before you do.
You said a minute, so I kept it to a minute.
I would just like to layer that beautiful and glorious piece of lumber that my friend Chris Vecchio just chopped down and laid across the road as yet another reason why your good friend and neighbor over here on this side of the screen is full bull, my friends. Long the bond, short gold, short silver, long the dollar. Because not only are there multiple pillars of super growth hiding in plain sight, but inflation is a non-issue, as my good friend Dr. Vecchio said. And now I shall hold my tongue so that you can say what you must, my California-based friend.
I won't argue with anything Chris has said, because everything he has said is correct. It is also fully priced in and has been fully priced in for a very long time. That is not a premise to not care. That is a premise to say, okay, well, here's the baseline. Now, what's the likelihood that we get something shocking off the baseline? And an indicator that Chris and I like to watch is the interplay between the ISM services component of the component of inflation in those numbers, because over the past decade, they've tended to front run CPI and PCE by about 2 months. That reading came back as the highest since November of 2022 in the most recent report, despite the fact that the overall service sector shrank. So it didn't come from growth. That would be right around now that this should show up. And it would keep the Fed on the sidelines, even if it doesn't show up this month. But the question isn't, will the Fed be or not on the sidelines? Because that's priced in. The question is, does the market want the Fed on the sidelines? And is the market happy with that idea? and looking at the break-even rates, the answer is no. Because as we've started to see rate cuts get pushed into the long bond, stocks have pointedly capped their rally and transitioned into whatever this slow, low volume drift thing is. And so for me, the revelation isn't going to be that, oh, the Fed doesn't have to cut. No, we know that already. The question is, what does the market do with that when it knows about growth? When it gets the confirmation from hard data.
What if the hard data never rolls over? The soft data started to normalize a little bit. People are getting a little bit less worried about inflation, a little bit more confident about their finances.
Where?
People are less concerned than they were. We just saw this thing.
That's not what the University of Michigan.
Haven't you heard, Ilya? That's what the people say. That's people, man.
People are saying.
People are saying,
man.
They're not saying it to the University of Michigan, I tell you what, because they just released their consumer confidence numbers, and they were terrible again. Now, they were a little bit anchoring at these low levels. They hit a 3-year low in April, and they didn't get off that 3-year low, but they also didn't go lower than it. The conference board numbers are for April, and they were still awful, just less awful.
Conference board was bad in April, but then it jumped by 12.3 points in May, and its largest single month increase in 4 years.
Yeah, but look at where it's sitting.
Just below. Yes, so conference board is like a PMI in the sense that 100 is their break even.
Yeah.
But like present situation index is at 135.9. That's well above the neutral rate.
No, but that's normal. Look at where the overall conference board index is, because
but this is the difference. People are saying things are fine right now. We expect them to get worse, right? That's what's driving consumer confidence lower. It's not that things are terrible
today. Read your own
today.
screen here.
Yeah.
The expectations index remained below the threshold of 80, which typically signals recession ahead.
No,
it's there.
I got that, but if you make another surge like this in the next month where you're continuing to normalize because the tariffs are in the background and the pause is ongoing, then you're out of risk. But we've done that. Tariffs are not being discussed. Everyone's waiting for them to fall.
But that's not what. Again, we just got the updated University of Michigan numbers. We're going to get them again this week, by the way. So we'll get a sense. But the expectation for May is an expectation. We'll see. But there's no evidence to suggest that consumer sentiment is recovering. The evidence for now seems to point the other way. Now, maybe these May consumer confidence numbers on Friday tell us something different. I'm certainly open-minded to seeing it if it happens. But it hasn't yet. What we've seen so far is that businesses have been stocking up inventory that nobody is coming to buy. We've seen that in April, even as businesses were front-running the tariffs, consumers opted not to, even though they had more of an impetus to do that after Liberation Day and then the 90-day pause. They did not, though in March they did. We see that in the sort of GDP math here. Already in the first quarter, that's led to a significant decline in consumption. And if April retail sales were telling, then not only did consumers not come out, despite the fact that there was a reason to front run, they didn't come out despite the fact that businesses ate the extra costs for them, as we learned in both CPI and PPI numbers. That certainly looks like hard data to me. The question for me isn't that the economy is or isn't significantly slower. It is. The question is, when do markets care about it? And how much weakness do you need to see before inaction at the Fed scares you? And the price action since about May the 29th, let's say, maybe even earlier, the 22nd, suggests the carrying has commenced, albeit very cautiously. And if you get a CPI number here that's spicy, and the expectation is 2.9 on core, that'll be a 3-month high, then you're getting to a place where things might get spicy. Not because the markets know the Fed isn't going to cut. They know. It's because the fact that the Fed is not going to cut becomes a thing to fear.
Well, I think tactically, that's kind of where my head's at the past 2 days. For those who've been listening to Futures Power Hour and Overtime yesterday, we have the Fed meeting next week, the expiration, options expiration for June. July has been the best month of the year for stocks over the past decade. You haven't seen a red July for the NASDAQ in over 10 years. Over the past 20 years, it's up 85% of the time in July. So it's hard to justify, with that seasonality in front of me, for me getting too bared up. But you get through the expiration, you get through the options expiration, you're getting through your Fed meeting, and then you're at the end of the second quarter. And all the people who were the heroes and bought the dip in April, they can take some profit and pat themselves on the back that they did well for their clients. Everyone else, most people still need to chase, as we've learned. But the table then resets in July. New quarter, new quarterly performance that you can try to, make up for last one. More importantly, we're going to have potential rebalancing effects in indexes. And then I think you go into a period where, hey, you get through the July Fed meeting that there's no cut there. We are on our own for the month of August. We're not going to get anything out of Congress, maybe a deal perhaps on a bill, but typically Congress goes to recess leading into Labor Day. You're going to have a Fed at Jackson Hole. The calendar gets really short all of a sudden through the summer, where if you're a market watcher or participant, you say, geez, if they don't give us a cut by, in the next 6 weeks, we're probably not getting one for the next 3 months at the earliest. It's a little bit of a different conversation moving forward if stuff starts to hit the fan. And then, of course, we haven't even mentioned the tariffs, but no one's talking tariffs here. Dylan, I have one thing I want to talk about before the show ends, but before we go there, what do you think is the most interesting piece of news event unfolding around the world right now? And it could be because the market's not reacting to it, and it should be, or because it's clearly driving the market.
I mean, now you kind of put me in a bad spot because I started the show with what I think the biggest news item is, which is the burning Waymos. Okay. So, I saw it, but I don't want to just sort of churn and spend the last 10 minutes on what I spent the first 10 minutes on. So I'm going to say the biggest news item in the world is transportation. The biggest relevant news item on earth right now is transportation tech and the icon of burning Waymos. Set that aside. The unspoken piece of all this, and you touched on it for a second with the potential detachment of the equity market from the so-called real economy. If you presume that most of the most valuable equity in most of the most valuable enterprises is tech or tech-related equity that's tied to some derivative of AI or transportation tech, travel tech, fintech, med tech, blah, blah, blah. The unifying thesis of all of that equity is that it's more profitable than ever because it requires less and less of the traditional labor pool. And so you have a business, a domain of businesses and trillions of dollars in equity, all of which is generating huge margins and huge revenue, but in the process, not the job creation engine that a normal boom like a previous industrial revolution would represent, which only further fuels the underlying social unrest that is the single greatest risk to world stability and peace. And it's the reason why you have Donald Trump as a president. The reason you have all the alienation, the reason you have all the political extremism is because the equity value of enterprise is increasingly tied to remarkably efficient, infinitely scalable, highly productive systems that do not employ people as they once did. And so that's why the stock market can go cuckoo bananas. And yet not represent the so-called real economy, which then fuels the political extremism, whether it's deep left or deep right. And that's the single greatest risk to all of us. And it's ultimately going to become a wake-up call, which is that to have an economy that works for the benefit of shareholders only works if the shareholders' interest is aligned with the interest of humanity. If shareholders' interest is benefited at the expense of humanity, it will yield catastrophic results, the likes of which we're only seeing very marginal edging of activity around that right now, with, again, the Bernie Sanders candidacy a while back, the first Trump presidency, the sort of what I think the sort of manipulation of the Democrats to install Biden to avoid any real sort of change from a more viable candidate, whether it was a younger person like Buttigieg or a more extreme person like Sanders, or the fact that the Democrats then tried to rig it a second time by just jacking everybody with somebody who wasn't even voted, who wasn't even in a primary, and just trying to install them. All of that is very fearful defensive behavior, trying to avoid the elephant in the room, which is that the social component and the political component is vastly underqualified and unprepared and ignorant as it relates to the profound rate of change and incredible intelligence, both among the individuals, both the executive, the management of these companies, smart or extremely smart, organized or extremely well organized, the investors in these companies, smart or very smart, organized or very well organized, and the enterprises themselves, prosperous or extremely prosperous. And the political and social infrastructure is no match for it. And it is the underlying reason why the totality of the political system is in this sort of the throes of wild and extreme and idiotic behavior, whether it's fearful protection of power by the Democrats or reckless sort of, tossing around of idiotic policy by the current Republican administration. All is just a reflection of a group of people in the political and social class that are profoundly outmatched by a technological and investor infrastructure that is not aligned with the interests of society.
Ilya, same question goes to you. We've talked recession, Fed, we've talked self-driving cars here. Surely there's something that we're missing that actually matters to this market.
In my mind, what matters to this market continues to be incredibly simple. It's just the market has a varied reaction function. And what for us as traders becomes the challenge is to be right at the right time. And I think it's entirely logical that if the premise of the sell-off had been solely the administration is going to engineer some sort of a financial disaster because it is going to forcibly amputate the U.S. out of the global financial system, which would be a disaster on just such incredible proportion that it would be sort of like if the foundation of your house decided to build itself a tunnel and leave the rest of the house and say, well, y'all figure it out. If the premise was, oh, good, that's not going to happen, well, then this rally makes a ton of sense. And we know the market gets emotional about things like this. We saw them get emotional about it in April. There was a level of panic that was obviously elevated around the idea that the worst has occurred. You can't beat the U.S. from without. The only way the U.S. implodes is from within, and now somebody is going to do it. But that was never the logic. That was the amplifying factor. The logic was that the economy is slowing and the Fed won't do anything about it, and there is no one at the administration level that cares. So fiscal authorities are not going to U-turn. That continues to be, in my mind, the most important thing that's going on. Because none of that has become any better, but sentiment has improved. So for me, it's sentiment neutralized in early December when they said, well, let's see what they do now. Okay, we're back in that range. Let's see. But none of the promise of AI has changed since December to now. There have been no great breakthroughs to speak of that really changed the story of positivity in any kind of a meaningful way longer term.
Maybe.
So to me, this is just sentiment.
Maybe, but markets can stay irrational longer than most can stay solvent.
Yes, they can. Absolutely.
With that, Overtime's out of time for today. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after first call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. See you tomorrow. Of course, up next after a break, Ilya's back with Macro Money. He's also here tonight for The Price of Truth with Victor Jones, 6 Eastern, 3 Pacific, so be sure to stick around for that too. Good luck trading.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, like, I was hooked. I'd always seen all the stuff on tastylive with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from tastylive to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
I'm just gonna wait for the stock to dip, then I'm a buyer. Buying into weakness is a phrase used to describe the action of getting long a stock into a down move. It's a contrarian trade. Most people want to buy what's hot, the stuff making huge upside moves, the chart line moving up and to the right. Nobody wants the stock at lows. But it's hard to buy high and sell higher, rather than buy low and sell high. There is a phrase for this. When the time comes to buy, you won't want to.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Well, the markets take another quiet day to think about things as they wait for more event risk to hit the wires. We're, of course, still waiting to see how trade negotiations between the U.S. and China are going to go. We're still waiting for the start of economic data to really hit the wires this week. And that's what we're going to focus on here today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And for the next 30 minutes, we're going to see if we can break down what will be the first big piece of economic data this week and whether the markets should care about it. And of course, what we're talking about here is U.S. CPI data. We have in front of us what is the first kind of big piece of data for this week, and of course a week full of low volume drift in markets. So the hope is pretty much any place you might find yourself in the bullish bearish divide, that you get some conviction, that you get some sort of follow through and some kind of a break of the lull that we've seen here. So what we're going to do is go through and see what is expected, what that means going forward, and whether the markets should care. Now, the expectation here is we're going to get inflation ticking higher for the month of May, 2.9% expected on the core reading, excluding food and energy. That's the metric that the Fed cares most about, of course, because they don't really have much by way of agency over data that might speak to what's going on global food and energy markets. They can't exactly will those prices this way or that. And in any case, we can see from the breakdown here, almost all inflation for quite a long time now has lived overwhelmingly in core services. And so with that in mind, that's really the metric that we are most focused on here. And on that score, we are looking at the most significant inflation if we get expectations met here in 3 months. 2.9% would be a 3-month high, getting back to where we were or approaching where we were in February at 3.1%. It's a similar story for the headline, 2.8% in February, 2.5% expected. Likewise, a 3-month high. Now, in April, these numbers were, from the market's perspective, certainly, encouragingly normal. And what you see here is the contributions to those numbers. You can see the headline was 2.3%, down from 2.4. The core was steady at 2.8. The core services component overwhelmingly the main contributor, but perhaps the most significant thing here was you didn't really get a surge in goods inflation, which is what you might have expected given all of the Fed's worrying about the onset of tariffs. And of course, in April, we very much saw a significant increase in tariffs, the pause in reciprocal rates beyond 10% notwithstanding. Taking that pause as it occurred, you still had a move from the average tariff being 2% to the average tariff being 10%. So you have a 5-fold increase in tariffs. And the worry was that what this would mean is a significant increase in goods inflation that would hurt consumption, that would give you a nudge on the part of the economy that is the most significant. We've talked a lot here on Macro Money about the first quarter being the weakest contribution from consumption to overall GDP in close to 2 years, while at the same time accounting for 68.5% of GDP overall, which is not what you want to see. Certainly, that consumption is the dominant thing is the standard for developed economies, but that's why you don't want it at a 2-year low. So the concern was that you'd start to see that show up in surging goods inflation. And when that didn't present itself in April's CPI numbers, this was met with a lot of encouragement by the markets until, of course, you got the PPI results and you saw where that inflation went. Here is the month-on-month change in wholesale inflation, excluding food and energy. And you can see we're looking at some of the fastest rates in April going back 2 years. There's that big errant spike in 2023. And if you look through it as a one-off, as it looks to be, then you're going back to kind of the worst of the inflation surge in 2022 for your reference point. But that didn't show up in CPI because you can clearly see here what's going on is businesses ate the difference. They basically took a hit on margins, and you see here the negative reading on month-on-month PPI here, and you can see it appear in what is called PPI for services. This is the trade services component, which basically represents the cost of moving goods through the supply chain once it's in the U.S. And you can see here the hit on margins and ends up being something like 1.6%, which is quite a big hit for a single monthly change. So that drop in margins tells you that, as you helpfully get annotated here from the chart that I pulled from Bloomberg reporting on this. You get this hit to margins, and that's where the price increases have gone. That's how they're not, for the most part, in CPI. Now, looking forward, the ISM numbers that just came out last week tell you a story of very significant price pressure. It's evened out at a high level in manufacturing, apparently, over the past 2 months or so. That's somewhat encouraging, at least in the sense that things aren't getting actively worse. But in the service sector, you've had a dramatic catch-up. In fact, you are now looking at the fastest inflation, according to this ISM survey data, for services, which is by far the largest component of the economy. If manufacturing is maybe something like 20%, and ag is maybe something like 10%, then the rest is services. So about 70% of the overall economy. That's now at the fastest since November of 2022. Which kind of comports with what we're looking at here in PPI, absent, again, this errant spike in 2023. What's more striking is that you get this runaway inflation at the same time that the sector contracts for the first time in, give or take, a year. You'd have to go all the way back, and granted it's a narrow contraction, but you'd have to go all the way back to December of 2022 and then to April of 2024 to get some recent readings below 50. And you can see here that, at least sort of referencing the middle of last year, this is the weakest that the service sector has been. And of course, manufacturing had this run up around the front running of the tariffs, but now seems to have had that fizzle as the tariffs have gone from speculation to reality. And so it isn't as though you are getting this jump in service sector in inflation here against the backdrop of growth becoming stronger. That would be the kind of thing that's driven by robust demand and would be generally a source for optimism. That isn't what's going on here. Inflation is surging here at the same, and you can see the base here is the beginning of this year for the most recent bit. And of course, over the same time, what's happened with growth in the sector is it has been cooling. And again, this is the largest sector of the U.S. economy. So if ever you wanted a picture of stagflation risk, there it is. Moreover, that price component of the ISM services report has tended to anticipate with about a 2-month lag what happens in CPI, as well as the Fed's preferred gauge of inflation, the PCE index. You can see that obviously the ISM survey is more volatile, but you can see that in broad strokes, there is a trend following a kind of parallel set of developments here if you lag the PCE and CPI indices by 2 months. And of course, what that anticipates is if this now is an inflationary surge, most recently going into April and May, that should begin to show up right around the next several months in CPI and PCE, even if it doesn't show up necessarily in this month's data. So the risk is in the direction of reflation. And of course, these things aren't perfect. These relationships aren't one for one. So you'd have to set aside the idea that you know that this is going to happen this month, or you know that it isn't. What you do know, though, is there has tended to be this relationship, and it would tell you that over the next several months, looking out for a jump in inflation readings is what you'd be looking for, which of course the Fed no doubt sees. Moreover, when we had a similar type of situation last year, we saw inflation accelerating here. These are CPI monthly changes in 3-month and 6-month annualized increments, which the Fed looks at to kind of get a sense of the higher frequency trends in where inflation is heading. Even though they target year-on-year annualized, or 12-month annualized, they look at these inputs to kind of see where the wind is blowing, to try to anticipate, at least to some extent. And you can see that last year, as you had inflation building at the start of the year, the Fed, of course, became reluctant to cut rates and didn't ultimately cut them until here, September. While the president has said that the ECB has cut rates 10 times and the Fed has done none, that's, of course, not accurate. The Fed cut rates the equivalent of 4 times last year, 1 time by 50 basis points and 2 times by 25 basis points, which begins right here. But by then, this inflation spike that kept them on the sidelines and waiting was already quite a few months in. Now, of course, you don't have a Fed meeting in August, but as far as months with a meeting, here we go. They didn't do it in July, they didn't do it in June, and that was already 4 and 5 months since the spike, or the peak in this reflation. Now, arguably the peak in this one is sometime around January, February, and this would only be the 3rd or 4th month, depending on where you sort of tag this. That would be the 3rd or 4th month since. So under better circumstances last year, the Fed wanted to wait longer to really make sure that it's back on course to start cutting. So even if you get a reading in line with expectations here that doesn't muddy the waters, you're probably not looking at Fed action being motivated by whatever comes out. And with expectations as they are and with the muddiness there, you probably just endorse that. Moreover, in the same direction, we've been talking about this reporting from the Wall Street Journal this week and last, casting doubt on the veracity of CPI figures to begin with, because the hiring freezes and layoffs at the federal government since the beginning of the year have meant that the Bureau of Labor Statistics, which puts these data together, have had to rely much more so on implied figures rather than actual surveying of the economy and of the price levels in it. You can see here that normally before COVID, about 10% of the data was using these implied estimate methods because for whatever reason in a given month, a certain price point couldn't be had by the time the survey period was over. During COVID, not surprisingly, during lockdowns, we got up to just a touch over 15%, which you can see already normalized by the beginning of 2023 back to around 10%. But over the past 2 months, and of course, especially in April, it's surged to approaching 30%, almost 3 times what's normal. And so whether you want to say you should trust the number or not, it really isn't the point. The point is, if the Fed wanted to see lots of evidence to prove to it that inflation isn't going to be a problem and it can start to cut rates despite its concerns about the tariffs being inflationary, this kind of fuzz in the data just means they need more data points. So they need to wait even longer. Now, from the market's perspective, not surprisingly, what all this means is a very modest outlook for rate cuts. this year. You can see the markets have gone to 39 basis points now for this year. That's less than the Fed's preferred 50 basis points that they initially projected in December and reiterated again in March. It leaves 14 basis points of a second cut on the board. So 39 is 25 basis point cut, one fully baked in, and 14 basis points in the direction of a second one. That puts the probability narrowly better than even at 56%. Then for next year, you have just about the Fed's forecast matched here, 53 basis points baked in. In all, that's a little bit lighter than the Fed's 100 basis points, but very close at 92. But you do get the sense that the easing is moving into next year. So as you start getting under 50 for this year, you start to flirt with the idea, especially last week, that you might get over 50 next year because the Fed's dithering will mean more rate cuts later. But timing-wise, looking at this year's curve, you're barely priced in for a rate cut in September. It's about a 50-50 shot. It's there by the time you get to October, and you're about halfway to the next one when you get to December. But very clearly here, the market does not anticipate a cut when the Fed meets next week, does not see one in July, and is tepid for September. You can see the curve now meaningfully more hawkish than it was in the beginning of May when the Fed met, and in many ways more so even than when the Fed met in March, the last time they updated their summary of economic projections. So what does all this mean? Of course, the markets have believed that the Fed isn't going to cut in June and have been wishy-washy on July for quite a while. We've heard from the Fed at length that the problem facing them is that you have a situation where the tariffs as a basically sales tax on imports are going to be inflationary. And we've seen evidence of that show up in the PPI numbers. It's just so far they haven't been passed on to consumers. We're starting to see that pass through happen, looking at the PMI data, including the ISMs. And that sort of encourages the Fed's perspective that they need to be careful about cutting rates lest they let the inflation expectations demon back out of the cave where they have been trying to lock it for the past several years. And at the same time, they're concerned that what the tariffs will do in increasing prices for consumers is act as a dampening of sort of force on the economy, which of course we saw in spades in the ISM numbers that we just looked at. The economy has very clearly slowed since the tail end of last year going into this year. So what does all this mean taken together? Well, the markets have seemingly made their decision, and they're not leery about rate cuts, because what we see here as we compare inflation expectations, so-called break-even rates in the bond market with the S&P 500, is we see that when in the middle part of February, the tariffs started to show up in reduced business confidence and consumer confidence and started to sow recession fears, stocks were going down as inflation expectations were falling around that economic slowdown idea. Stocks have rebounded clearly. They're back to basically where they were at the start of the year, but these break-even rates have not. They're still suggesting that the risk is that inflation is lower, not higher, because the impact from tariffs will be a growth downturn, not an inflation shock. And that's where the Fed needs to focus. So if you get CPI data that confirms the Fed isn't going to come and move sooner, while the markets seem to think that they should, because the Fed hasn't made up its mind, but the markets have, well, then that just means the Fed is going to allow a deeper recession, and that may well see stocks shaving some of this sentiment wedge away and turning lower. It may also see gold go up as speculation builds for more rate cuts downwind as bonds rise and the dollar weakens. That is macro money for today. Come back tomorrow, as we do every Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, to see how all of this worked out, of course, and how to think about what comes next. In just 30 minutes' time, I'll be on with Victor Jones for The Price of Truth, so come see that as well. I'm back with Chris for Futures Power Hour on Friday, back with Victor and Tom for First Call on Sunday, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
If you had to buy and hold one stock for the next 365 days, what would it be and why? If you had to buy and hold one stock for the next 365 days, what would it be?
Aside from our own company. So if I had to buy one stock from now, 1 year from now, that might go up on a percentage wise, I think I'd buy Intel. I know you're going to hate that. I know everybody's going to hate that, but it's a $20 stock that I think is going to go to like 25. It's a nice little 25% kicker. If I had to buy another stock that's like in the same price range, I kind of like Southwest Airlines here.
Gosh, I know it's such a divisive stock, but I would say NVIDIA. It's just one of those interesting names that I think is sort of forward-looking, and the stuff that they're doing with chips and obviously the AI revolution. I've always thought that was fascinating. So it is definitely one that I think is here for the long term, and that's one that's interesting to me.
Tom said Intel. You have any thoughts?
Well, that would make sense. Tom is an Intel type of person. I mean, Intel started what year?
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Well, he's more public in his mentality.
I'm a believer. I believe that the world is good.
And I know that the world is not good. that questioning yourself and questioning yourself in dialogue with someone you respect is both pleasant and sometimes extremely insightful and useful sometimes.
If you had to buy and hold one stock for the next 365 days, what would it be and why? If you had to buy and hold one stock for the next 365 days, what would it be?
Aside from our own company. So if I had to buy one stock from now, 1 year from now, that might go up on a percentage wise, I think I'd buy Intel. I know you're going to hate that. I know everybody's going to hate that, but it's a $20 stock that I think is going to go to like 25. It's a nice little 25% kicker. If I had to buy another stock that's like in the same price range, I kind of like Southwest Airlines here.
Gosh, I know it's such a divisive stock, but I would say NVIDIA. It's just one of those interesting names that I think is sort of forward-looking, and the stuff that they're doing with chips and obviously the AI revolution. I've always thought that was fascinating. So it is definitely one that I think is here for the long term, and that's one that's interesting to me.
Tom said Intel. You have any thoughts?
Well, that would make sense. Tom is an Intel type of person. I mean, Intel started what year?
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. Tasty Live's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
What is going on, everyone? Welcome back to Risk and Reward. Back with Gus. We're doing the tier list again. We're going to be getting into some of these Mag 7 stocks. We're going to be re-ranking some of these, but we do have a lot to catch up on, Gus. I mean, some things really hit the fan. But before we get into all that, how are we doing today?
Yeah, doing good, feeling good. Certainly a lot to catch up on.
Yeah.
It's been a busy 3 days in the market since I last talked to you. We have a lot to cover. Excited to do this tier list. And for those that saw our tier list last time, we're going quicker this time. All right, this is going to be rapid fire. We're ripping through this thing, so it'll be fun making our adjustments. But feeling good, as you know. The long delta I have going on has not subsided yet. I am slowly taking profits, and it's slowly coming off the board a little bit. But yeah, green days are good days as far as I'm concerned for the time being, and it's been going well.
No, I hear you. I feel like, mine's kind of been just dripping on over to your portfolio because as we stayed towards these highs, my short delta isn't really liking that. So we got some things to go over. I just feel like every few days we always have something new to talk about. Like I know we have a lot of the Trump Musk fiasco going on. We got a lot of things to catch up on. It feels like every few days we always got something. And I mean, the market is really showing that volatility. So I'm excited to catch up onto it. But these Mag 7s, a little bit more of a rapid fire this time, Gus. Before we even get into it, do you already have an idea of some that just sticks out like a sore thumb where you want to re-rank right away?
Well, yeah. I mean, I think Tesla needs to drop a little bit. In lieu of recent events. We did this a week ago today, which we covered the Musk-Trump beef our Thursday stream last week, but this was done prior to that. So Tesla has taken a slide. It has recovered a little bit already. I suppose that there is maybe an angle to present that this just means that it has upside left on the bone. But I don't know. The way I'm seeing it, you kind of have this alienation of both political parties going on right now. I don't know. It's a tricky spot for Tesla, and I wouldn't want to rank as high as we have it.
No, I mean, I think it's a lot to do with that uncertainty again. Like as if Tesla and Elon didn't breed a lot of uncertainty already. I mean, this whole fiasco, like we were seeing going down on Twitter and on the news, I mean, just really adds to it. So I mean, I'm in complete agreement with you here. And I mean, we'd seen the initial sell-off whenever we've seen those tweets coming out, things hitting the fan. But we're rebounding fairly decent the last couple of days. Did that catch you off guard? I mean, it surprised me a little bit because, I mean, we've almost erased the downside move that we put in since this hit the fan. So,
Yeah, it did certainly catch me off guard a little bit, and honestly, I was kind of shocked by how quickly the entire thing blew over. It was like it was happening, and I was
That's
like, oh
just
my
the
gosh,
game.
this could tank the market. And I thought maybe we were going to get some volatility out of it, and it kind of just went away. The market, as it's been saying to many things recently, said, we do not care, and kept on going up.
Yeah, that's a really good point. It feels like the market's blowing it over, but it really reminds me of, and I know this one's going to be rapid fire, but it really reminds me of just like even just the trends that we see on TikTok, that we see on social media. It's like there's so many more new trends, things come and go so more quicker. It's like we're just like fed so much information in such a short amount of time, and that's what it feels like with some of this news that's going on in this market volatility. But we got Tesla. What are we feeling? We're feeling like a C or a D. I'm feeling more of a D. I'm really not ashamed to put Tesla in D right now.
I think that's fine. I think that given the recent drawdown and given the uncertainty, I'm fine with D tier. Next thing jumping out is I think Google should move up, maybe just up one to B. Had a nice little rally this morning. Has finally been kind of looking like a stock again. We were channeling for a little bit there. So yeah, nice little rally out of Google. I'm willing to give Google the bump up.
Yeah, no, I'm liking Google. Google feels like a little bit more of it feels like stability when we talk about Google in relation to some of these other underlyings too. So I like that one. Let's go with Apple for the next one. How are we feeling about Apple? I'm always a big bull typically when it comes to Apple. So I mean, I'm not against pushing them up to B, but I don't know what your sentiment is at right now. We can go ahead and check what they've been up to as well.
Yeah, I don't think my sentiment has changed much from last week. I mean, we're just kind of in this channel. Apple's been doing a whole lot of nothing for a little while now. And I mean, it was a disappointing first day of the WWDC today. I know that everybody was kind of let down with what Apple put forth. And it hurt Apple today. It prevented Apple from rallying alongside the rest of the market. So yeah, I don't know that I necessarily feel a change is warranted for Apple, but I suppose the antithesis to my point here is that it's Apple. And, it's not like it's going to stay down forever. It's bound to make a move sometime. Yeah. But I'm not seeing the catalyst for it yet. So I don't know. I would push back on you on that one. I think Apple's fine at C.
That's a really good point. I guess the angle that I'm coming from is the fact that it was a little bit of a letdown. Apple has been showing to be a little bit resilient, even with the letdown. So that's where I see.
And Apple also, to your point, Apple is absolutely something that any institutional trader, any bargain hunter is going to be hopping on dips in Apple that maybe wouldn't be classed as a dip in any other stock. But when you're talking about a Mag 7 stock, you generally expect that recovery to be a lot quicker, a lot of eyes on it. So yeah, I don't know. I certainly see your angle.
A great point.
Great point. I did. I closed the Apple risk of the week that I had open from a couple of weeks back today for a big loss. So maybe I'm just a little bit salty that Apple couldn't make that move for me. But yeah, I think it's fine in C. I don't really know if there's any other changes. I'm feeling like is Meta still ripping? I mean, Meta maybe could get the bump up to A tier.
Meta's still almost trading near its all-time. Meta looks a little bit more like the overall market. I know if we pull up NASDAQ real quick, NQ kind of looks very similar to Meta, kind of, getting really close to those all-time highs again. So looks like it's following suit. That correlation looks like it's pretty high on Meta right now. So we have Meta in B tier. I mean, how are you feeling? What's your sentiment on Meta?
I don't know. I think Meta could get the bump to A. I don't know. I think we could also leave it where it's at. I mean, in a broader long-term context, I don't know if I love it as much as Amazon and Nvidia. But if we're talking about just until next week, yeah. I mean, I think it's the chart's looking the same. It's similar enough to Amazon and A tier to warrant the bump.
I know that is true, but then do we warrant the bump for Amazon? Because I mean, Amazon has still been pushing strong ever since we had put Amazon, in this A tier 2. So I think that warrants maybe a similar conversation if we bump that one up.
I think that's a fair point. Sure. Let's shift this up a little bit. Let's create some upward pressure in our
So we're screaming all-time highs. It looks like we're positioned for all-time highs. I don't know if that's what we're going to get, but we got Nvidia in S tier still. Has any emotions changed about Nvidia here?
No, I wouldn't say so. I think Nvidia is S tier. I said it last week. Nvidia is AI. I don't think they're going anywhere anytime soon. Until given a reason, I think Nvidia stays in S tier.
Yeah, 100%. So that's going to do it for our rankings. I mean, the only big adjustment for the most part was Tesla. I know we kind of brushed over Microsoft. I don't believe Microsoft has been doing anything too crazy. I think we can leave that one in the same slot. I mean, Microsoft's been consolidating. I know we poked up to like an all near, trading towards that all-time high. but nothing too crazy. I would leave it at
Yeah,
that.
I mean, I don't know. It made a new all-time high. Should we give it a bump? You know, like a little popsicle after the baseball game here from Microsoft.
It does warrants the conversation. We can do it.
I mean, we got it in C, like all-time high is like we gotta at least put that thing in B.
There we go.
There we go. Now we have an F. Now our tier list is an F.
There we go. It's a clear F. This is going to be the S. So S tier, we got NVIDIA, Amazon. A tier is going to be Meta. Google is going to be B tier along with Microsoft. C tier, Apple. And D tier, Tesla. It looks like we got some people calling Tesla for $30 stock. That's got to be Tom's alt account. That's got to be his burner account. Microsoft's been doing really well lately. I mean, the IV rank is completely dead on Microsoft. I mean, hence, it's trading at its all-time highs. But that's going to do it for the Mag 7 stocks. We comfortable with that until we swing back around to that, Gus?
I think this feels fair to me right now. Yeah, given what we're looking at, I'm with it.
Awesome. Not too much has been happening on my end. I know you were talking about your long delta in your portfolio. I mean, these last couple of days, some insane price action. I mean, in my eyes, at least. I mean, some whipsaw type price action. We've seen some aggressive sell-offs towards the end of the day and then just immediately get bought back up. So you can imagine with my short delta, I see that sell-off. I'm thinking, okay, finally, here we go. Finally, something. Nope, we get bought right back up and pretty much like nothing happened. So right now we have the SPY position, 10 days left till expiration. Unless something dramatic happens. I know we have CPI an hour before the bell tomorrow. Unless something dramatic happens, don't see too much changing with this position. Same thing with NVIDIA, 10 days left till expiration. And then Disney. Disney was one of the risks of the week, Gus, and don't count me out. We got 38 days left till expiration. Something could hit the fan. Okay, don't count me out on this one, but Disney had a huge pop today. So we kind of were poking towards that all-time high on Disney today. IV rank sitting at 10. I did buy a put. So, if we do get an aggressive sell-off, I mean, goodness gracious, look at Disney right now. Look at this gap that we have on Disney. Look at this other gap we have on Disney. We consolidate for a couple weeks, and then we just straight rip to the upside. So, I mean, this happened in such a short amount of time. But if we do get that sell-off, maybe we get some pumped-up premiums, and maybe can spike those contracts. That put contract that I'm holding on Disney right now. So that is the hopeful game plan that we have right now, Gus. And I mean, sometimes hope is the best strategy. So we'll see how it pans out.
Yeah, that looks pretty juicy to me right now as well. Yeah, that does. It looks like a good spot to sell some premium here as it pertains to your trade that you've already had on. I don't know, but you know what they say about gaps, man. You got over a month left. Who knows? A lot of room to move.
Yeah. No, we'll see what we get. Anything else that kind of stood out to you on your end so far for this week?
Qualcomm finally moved. Thank
Qualcomm.
Yes, I was waiting on this move for a long time. Finally got it. So my naked 160 call has jumped into the money, and I also have a longer dated 170 that I'm waiting on. But very, very good move. This was the profit driver for me today.
Separate positions that you put on in Qualcomm?
Yes. Gotcha. I have a. Let me get specific here. I got too many positions is what I'm learning.
I mean, they put in 2 great days to the upside. Wow.
Yes, I have a July 18th 160. That's the one that moved into the money today. I guess it's slightly out of the money right now. And then I have an August 15th 170. So those are about 30 days apart. 38 DTE and then 66 DTE on the second one. I was just playing recovery out of the lows. And it looked for a while like that might not have been a good play, but it's since come to fruition. So I'm pleased with that move on Qualcomm. Other things catching my eye today, I got short Chewy into earnings. That was one that I posted in the follow page. I just think that this is overextended to the upside right now. I talk a lot about this is an earnings strategy that I enjoy, is trying to find things that are already a bit overextended, or I like to say pricing in earnings too much. And Chewy's expectations on earnings here really aren't anything special. They're projecting like 3% year-over-year growth, and it's just, I don't know. It's pretty modest projections for the run-up that it's had, and I find it very hard to believe that this could sustainably continue to move up anymore based on the modest projections that we have at our disposal right now. So I did get short there. Let me find this. Holy positions. I really need to close some things for real. I bought 3 DTE just the June 13th, just trying to play this earnings call in a vacuum. And I sold 50 calls, bought 51. So short, it's a bearish call vertical I got going on this one. And just hoping that we can't sustain this move out of Chewy anymore. Other than that, yeah, nothing catches my eye too much. The recovery on Tesla is something that I've been paying attention to. I'm surprised that happened as quick as it did, but also the whole situation blew over way quicker than I thought it would. So I guess maybe things are just happening a little fast for my taste. And then also shout out to Rivian, who closed the day break even to the cent today. Did nothing for me. Didn't hurt me, but didn't help me either.
I mean, over the last year on Rivian, it looks like it's been pretty much trading within this range around 17, 18 to the upside.
It's going to break out.
$9. Yeah.
We're going to the
moon. We haven't gone anywhere, guys. We haven't gone anywhere. No, I mean, I love it. QCOM put in some really nice days for you. Chewy, it looked like the volatility was nothing too crazy in Chewy. It kind of looked like it was lacking some liquidity, but I mean, it's traded 10 million volume today, so I mean that's really not bad.
It certainly was lacking some liquidity. I actually
it looked like it off.
I kind of got blessed with my fill. I really thought I was gonna have to fight to get that one filled, but it went straight through. So shout out whoever got long Chewy against me. You're a real one.
You're the real one. No, I was just looking at some of the price movements, just looking at a lot of those dojis, a lot of those dashes. It just doesn't look super liquid. So shout out. Whoever filled that Chewy position.
You remember Chewy in 2020 though?
Of course. I could be mistaken. I could have swore Chewy started off as like a Shopify store. I could have swore they started running and then it like blew up past. What is the backstory on Chewy? What was it again in 2020? What were you referencing?
I'm not too sure. They IPO'd in mid-2019, so it could be like just predating that IPO that they were a Shopify site. I'm not sure about anything pre-IPO. But yeah, 2020, it went ballistic. This is something that I was trading like once a week minimum in 2020 was Chewy and AMD like every single day. And it was just because coming out of that, it was like mid-COVID, but this was one of the weird stocks that COVID helped. Yeah. They're a at-home pet service, they ship things to you, and anybody that was shipping things did really well during COVID. Except for Zim, rest in peace. But they, if you're selling things online, you did well during COVID in the first place, and then they got the COVID recovery out. I mean, this thing was just free money for like the entire year of 2020. I would just get long Chewy almost blindly once a week, and it would work out. So yeah, that was a good year. And then 2021 was the opposite. The market priced in everybody being able to shop for their pet food again, and it's kind of just channeled ever since like early 2022. But yeah, I don't know. I like Chewy. I love them as a company. They do really great things, and I've seen them do all kinds of things going out of their way for people whose animals have passed away and things like that. So it's one that I would like to see succeed. I think that it's a very strong business model with no clear competitor in the market right now, save for traditional e-commerce giants like Amazon. And they have this subscription service, which has kind of been taken off as well, recurring subscriptions for your pet's food, cat litter, anything you might need regularly. I think that makes a lot of sense for pets. Your pet, you feed them very consistent amounts. Like on Amazon offers the whole subscribe and save thing, and I never do it because I'm never exactly sure when I'm going to need my next purchase of this product, even if it is something I buy regularly. But with your pet, if you have a 50-pound bag of dog food and you're feeding this dog 2 cups of this every single day, you can quantify to the day when you're going to run out of dog food and really nail that subscription. So I'm high on that as well. I like them moving forward. But yeah, in the short term, bearish. Just think it's a little overextended. And I sold the 50, so we would need like a 12% move to the upside on top of this run that's already happened. I don't see it happening.
No, yeah. I mean, nobody meal preps better than a dog. I mean, you can quite literally quantify it to the meal, to your point. And this was in 2020 when we had that rally that you were talking about. We just went back a few years. This was that rally. I mean, you bought any dip while Chewy was rallying. I mean, we ripped from, 20s to all the way to the 100 to about 120 and then sold off from there. So, I mean, this thing went straight up. But no, Chewy, the industries that have pets, like people can be so passionate about their pets. I didn't really grow up with too many pets, but to your point again, the industry, I mean, if you're selling anything at that time, and then, I mean, when it comes down to your pets, I mean, people will spend on their pets as if it's their child. So, I mean, I can see, why Chewy's been so successful. They've executed really well.
Yeah, absolutely. Yeah, people love their pets.
Oh, yeah.
I think the pet industry as a whole is growing. And something interesting I was reading while researching this earnings today is that like pet adoption rates are actually something that analysts look at a lot to try to price in Chewy's earnings and how things are going to move. Are pets being adopted? Because every time a new pet gets adopted, that's a new potential Chewy customer.
Right.
And pet adoption rates have stabilized. Apparently they were falling in late 2024 and early this year, and now they have stabilized. So Anybody adopt a pet?
Good to know.
I'm loosely in the market for some cats. I might join that.
I was just about to ask, are you a cat guy or a dog guy? I think you had.
I find myself being a cat guy as it pertains to my own pets. I love dogs, love being around them. I love all my friends' dogs, but dogs are a lot of work. It's higher maintenance. I like cats. They're like me. They're chill. They take care of themselves, and they come hang out with you when they want to. It's just lower maintenance.
I've never been a big fan of cats, but I mean, I will do a Bengal. I think a Bengal is pretty fire. I think those cats are gorgeous. The skin of those cats too. And I mean, that's one I would consider. But other than that, I'd have to go on the dog side a little bit. But not to get too off track.
It's pros and cons to both.
It is pros and cons.
I admire people that manage to have both and they can coexist in their houses. It's it's always a fun dynamic. Little Tom and Jerry action.
Exactly. The
I'm aware Tom and Jerry is not about a cat and a dog, guys. Nobody correct me.
I feel like it was before your time. You grew up watching Tom and Jerry, right?
Yeah. I watched Tom and Jerry. I think Tom and Jerry is pretty timeless. It's like a Sesame Street kind of thing.
It's definitely timeless.
It just hangs around. I don't. Do you know which is which? I think Tom's the cat, right?
Tom
because he's a tomcat.
Cat.
Is that?
I believe Tom is the cat.
Mike asked, do they have supplies for chia pets on Chewy? I don't know, but they probably have supplies for birds, which is usually seeds. So maybe you could figure out how to feed your chia pet on there.
We could do it. The volatility index kind of been dwindling down here, Gus. I mean, I know we have some more binary events to wait for, like CPI an hour before the market, but I mean, volatility has been relatively quiet. We keep getting bought up. We know we have that inverse correlation with volatility. Do you still have on that long VIX? It's looking like we could get a pop here. I do. Soon.
I do, yeah. It's a naked 17 call, just moved out of the money right before close today. But shockingly, it is long dated. I'm still 70 DTE. But shockingly, this thing has only moved down since I bought this, and I'm only down about 5% on the actual notional value of the contract. So yeah, still feeling fine about that. Still just have this thing chilling out, acting as my hedge. That's the bull flag to end all bull flags right there. Holy cow.
I mean, I don't even know what's going on right here. So I know last night we traded in one of the smallest ranges yesterday, which was just about right here. We rallied out of market open, put in the high for the day. We put in the low and the high for the day within the first hour of the day yesterday. And then we traded within that range. We sold off. The futures market opened back up, and then we just absolutely ripped to the upside, dwindled off, sold back off to the downside, and then today we pretty much just chopped around all day. We had one point to where we sold off and immediately got bought straight back up, sold off, immediately got bought straight back up. So, we'll see how the market digests everything that's going on. I know we pretty much put in a 20% plus month to the downside and then a 20% plus month to the upside. So maybe the market wants to finally give us some sideways actions. I feel like we're always talking about what's our bias? Are we going to put in more upside or downside? But what if the market chooses to sit sideways for a little bit, which, that's a premium seller's dream if volatility is high enough. But we'll see how we digest everything.
That we will. From where I'm sitting, though, I do not want the sideways market. We can continue with the chop.
Absolutely. But I mean, especially not right now for my positions, because we can get the sideways markets when they're sitting or when my positions are sitting out of the money. Some of them are in the money right now. So if they stay there, my positions are cooked. But, if they were to be sitting out of the money, I wouldn't mind if we had a little bit of sideways action. So see what we get.
Nobody ever became a millionaire by a stock moving from 170 to 172. We need these things to do some moving.
No, I'm excited for the next outlier move that we get in the market. I'm excited for another underlying in the market that has a story attached to it and that gets the public involved. I miss those times. It's been too long.
Yeah. I don't know. Has it? I feel like a lot of people are still reeling from the last one that we got in April. But the volatility events. The volatility events floweth freely in the Trump administration. That was the case in the first administration as well, and it's fun. I think it makes things fun. It's maybe not as great for my long-term portfolio or my retirement account or these things, but in a pure vacuum, tasty live sort of context, I'm all for the volatility. I want to trade small and trade often. Damn it, and I can't trade often when things go sideways.
Yeah, no, I hear you, especially with VIX sitting at 16 right now. So we need something to pop off. If VIX is sitting at 20, 30, I'm going to get a little greedy. I'm going to be selling a little bit more premium than I usually do, but we'll see whenever we get there. It could be tomorrow. I mean, it could be in 2 days. I mean, you never know. This market moves.
It could even be 3 days.
It could be. You don't know what we're going to get. So super choppy day Monday and Tuesday. Premium sellers were absolutely eating because, I mean, if you were buying options and bag holding any type of options, those probably went to zero very quickly. But I know it's been a more difficult environment the last couple of days. We'll see how the rest of the week plays out. We are coming to a close here. Anything to add before we hop on out of here, Gus?
Yeah, no, nothing to add. I hope the volatility keeps coming. I hope Qualcomm keeps moving. Hope everybody's having a great time navigating this volatility. And I apologize to you if your retirement account has been affected by these events.
Hey, well, we might hit all-time highs, so retirement accounts might be looking nice. It's true. We ripped to all-time highs, but
That's true. It has been a V-shaped recovery. It
has been a V-shaped
for all intents and purposes to this point. So yeah, I mean it's the textbook example, first one we've really seen since COVID. Yeah, it's fun. I'm having fun.
Yeah. I don't know what Trump is doing, but I know March 2020, the market sold off and it went straight back up. So whoever's hitting buy, continue to hit buy, and we'll see whenever the market pans out. But that's going to do it for today's segment. Thanks for joining us. Be sure to stay tuned for more segments coming on next. We will be back this Thursday at 4:30 Central Time, and we'll see you guys next time. Peace.
At Tasty Live, we live and breathe the markets. But when the live show's over, are we out of breath? If you want to inhale the latest breaking market news, we've got you covered. The Tasty Live research team and on-air personalities post refreshing content updated daily covering earnings, economic reports, trade ideas, and much more. If you want a breath of fresh air and not stale takes, visit the News and Insights tab at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, $4,000, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the Tasty Live core strategies.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade. right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
Oh, yeah, it is Tuesday, June 10th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's Evening Show, a little podcast, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. And we've got a healthy dose of them to chew on since I haven't talked to my man here in 2 weeks. So we got a lot to catch up on. I'm super excited for that. Before we get started, shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile application. But if you want to be part of this little chat box in the middle of your screen, did I get it? Yes.
You got it.
Such a sick looking stream they got going on here. Shout out to the production team. If you want to be part of the chat box in the middle of your screen, there's only one place to do it. That's on the evil Google YouTubes. So head on over to Tasty Live's YouTube channel, subscribe, and then your thoughts, both appropriate and otherwise, will stream unedited and unmoderated in the middle of the stream. Do with that with information what you will. The production team just got so pissed off. Like, why would you do that? Why would you put us under that type of pressure? It is Tuesday, everybody. You know what that means. It's time for the big brain, the one, the only, the global head of macro here at Tasty Live, Mr. Ilya Spivak. Ilya, how you doing, my friend?
Very good. I spent the weekend up in the Russian River Valley amongst the redwoods, catching my zen, taking in nature, and getting ready for what is hopefully a week of fireworks this week after this low-volume lull. But I am re-energized and ready.
See, to most San Francisco hippies, I would think going out and spending some time amongst the redwoods, when you say Zen, taking some time in nature, to what everybody else thinks is just kind of, maybe doing some yoga, some light stretching, looking out on the beautiful, serene forestry. They don't know you like I know you. What being in nature for you means is you blindfolded yourself and took turns unassembling and reassembling your guns, and likely caught squirrels with your bare hands and showed your small children how to debone and eat them over a 2-day period.
I'll tell you a funny story.
How close am I? How close am I?
I'll tell you a funny story about how off you are. As my wife and I were sitting at a fire pit in the evening at a
Did you make the
fire? No, of course not.
Who made it?
It's
like
a
a man-made
reasonably
sort of
fancy
thing?
bed and breakfast with a gas
you ate
operated fire fire pit as we sat there, and a little baby fox ventured out of the woods just to kind of move around, see what's going on. My Queens native wife, who wouldn't bat an eye at the sight of multiple crackheads, went, "Oh, there's wildlife here. We're going back to our meeting."
Bro, I grew up in Michigan. I grew up in I don't want to call it the sticks, but I was close enough to it, to a lot of nature growing up. And I was in the Boy Scouts as a kid. So I went out there, learned how to make fires and stuff like this, but I hadn't done it in a really long time. Okay, so
no, you're right, though, that I'm from the Soviet Union and we went into the uncharted forest to do this kind of stuff all the time.
I know.
I don't have the audience for that kind of thing around here.
You've sort of, exactly. You've put that part of you, buried it somewhere deep inside your soul. But if push came to shove, and the purge came, you would know what to do. So my son,
I still have all of my equipment from descending into the Yosemite wilderness for days and then coming out later with everything I needed on my back. I still have all of those things.
So I took my family camping one time so far, and they loved it. Even my wife kind of was like, she's a city girl, but even for her,
well, my wife's not about it.
She had an okay time, and there was this moment when we built a fire where we all went out, we found kindling of different sizes, broke up the branches. When we got home, broke down the newspaper, set up the fire, and got it going. And there was this look in my wife's eyes as she looked at me. And I could there was a primal look, oh, you can take care of us. This is kind of, and I looked at her, and I've seen that look before. We've got 2 children, Ilya. I've seen that look before. And I said, kids, get ready for bed. You go to bed early.
Yeah. Everybody is going in the tent now.
Ilya
Hopefully
Spivak,
you brought more
friend.
than one tent.
We did.
That's the key to this endeavor.
And some gummies.
That's right.
Ilya Spivak, 6,050. Cash was up across all 4 majors here. S&P up about 0.5%. The NASDAQ up about 2/3 of 1%. The Dow Jones up 0.25%. And the Russell continuing to show some strength here as, again, I said this like a week ago, they're going to start saying the rally's broadening out, and that appears to be happening at some level. And the worst thing that happens here for everybody is this thing just keeps grinding higher. It doesn't give anybody a reason to get super excited about markets. It doesn't give anybody a reason. It doesn't give the bears any ammunition. We're at 16 and change in the VIX, my friend, 1695. What gives? What gives, Ilya?
It's an interesting sort of thing, and I think the low volumes that we've seen really kind of speak to this idea. If you wanted to think about the S&P here as a kind of creature of sentiment, then it kind of makes sense where we are. But if you think about what actually started the sell-off mid-February, let's call it, through the end of March, then you know that it's not a creature of sentiment solely. But everything that we've been concerned about, everything we've been talking about for weeks has been Trump said this, and then Trump said that, and then he threatened this on Liberation Day, and then he walked it back, and now the taco trade is a point of conversation. And if you haven't heard about it, taco, Trump always chickens out, is that acronym. And the reporters, like, it's become so zeitgeist that reporters are rage baiting the president in press conferences by telling him about it. So this, to me, is emblematic of the idea that the markets are complacent enough that if in sort of early April, the hair on fire narrative was, oh my God, the U.S. is trying to surgically amputate itself out of the global financial system, and it is the pillar of that system, and then it's very clearly not that, it becomes, oh, well, if it's not that, then everything is fine. But the reason for the sell-off wasn't that. That came later, or at least the fear of that. That came later. The sell-off was always about business confidence and consumer confidence are starting to slide, and if you believe the surveys saying that this uncertainty is around the implementation of fiscal policy and of the administration's policies more generally, with a focus on the tariffs, you can take that at face value or not. It doesn't matter ultimately. The bottom line is when the PMIs, the ISMs, the consumer confidence numbers, when they start going dark quickly, the market gets spooked. And it's a cyclical-minded sell-off. Well, the cyclical story hasn't improved at all. Ostensibly, it hasn't gotten worse, but it hasn't gotten better. And so now you've basically reset. And if you're out there on the sentiment ledge so far out that you're saying, none of this matters, he always chickens out, whatever. If you're that far out and you think that's what's going on, well then, and if that's representative of the zeitgeist, then you're vulnerable. And you're vulnerable because the real economy does matter. And it's not looking any better, and valuations have reset to the last spot where they mattered.
A lot there. Let me ask a follow-up question before we unpack it. What say you about the current Atlanta Fed GDP now estimate, which is now 3.8%, which has even come down a bit from where it was at over 4% not long ago?
Yeah. So I think some people, and I've seen this start to get tossed around on social media over the past several days, finance Twitter has been debating a little bit the veracity of this model and goes, how can it be that it's so volatile and it's so high? And it seems to miss the point. This is not a forecast. It's a nowcast. It's a live moving thing. And we're very far away from second quarter GDP data. So there's going to be a lot more inputs that go into this model that make the numbers look like something that is a reasonable anticipation of what the actual results on second quarter GDP might be. For me, actually, if you go back to the chart of the Atlanta Fed here, the thing that's the most striking isn't that the model is kind of wonky when you're so far away from the numbers. It's not based on very much data here at this point, but it's the spread in the blue chip consensus. This thing thinks growth might be anywhere between 0 and 3%. So basically nobody has any idea what's going on. The level of diversity in these forecasts is much greater than usual. Typically, you're sort of looking at a consensus with analysts clustered around maybe within a percent range up and down, usually even tighter than that. Here you have a wide disparity of views. And so nobody seems to really know what's about to happen in the second quarter, and that speaks to sort of general market uncertainty.
What would you price the probabilities that GDP growth is greater than 2%? Regardless, okay, so let's say you think 3.8% is aggressive. What would you say the probabilities are that GDP in the second quarter is greater than 2%?
I would think it's probably something on the order of 30%.
What would you say of Polymarket? Polymarket right now has those odds at 80%.
Yeah.
What do you think about that?
It doesn't surprise me, given sort of the tone of sentiment.
Wouldn't just logic tell you that if everybody pulled forward imports into the prior quarter, which was one of the biggest reasons why you saw a negative, sort of an ugly GDP number, and one of the reasons I think why most people look through it, that the exact same thing can happen here but in reverse. What does Ilya Spivak think about that possibility?
I don't think it happens in reverse. I think it happens the same way. And I think the reason it happens the same way is because in the second quarter, if we had an impetus to front run tariffs in the first quarter, we have a bigger one to front run them in the second, because Liberation Day was the reciprocal tariffs. And so the nature of the threat become known in early April and then are put on hold for 90 days. And so what we have is a greater impetus for businesses to go, oh, now we see how bad it can get, but there's a 90-day window where we can see if we can buy a bunch of stuff before it's real. So I think there is further goading, not less. But the real issue for me isn't even that, because the giant swing in imports and the giant swing in the investment component of GDP in the first quarter because of huge inventory stocking, those components of GDP, they're not big. GDP is 68.5% consumption. And consumption was at its weakest in almost 2 years in the first quarter. The real scary bit here would be if consumers didn't match the front running. They did in the first quarter, to some extent. In particular, you saw it in March. By April, you get a really nasty mix where the PMIs are telling you that there's still a ton of inventory restocking. So if you read the PMIs, be it from S&P Global or from ISM, they'll tell you the restocking push to front-run tariffs continues into the second quarter. But by April, what you get is CPI that doesn't show a surge in goods prices, but PPI that tells you it got stopped short at the wholesale level because businesses ate it and put it into margins rather than pass it on to consumers. And still you get a weak retail sales number because consumers don't go front-running the tariffs in April. We haven't seen the May numbers yet. We'll see. But what you then get is this picture of there's all this restocking of inventories, but consumers aren't coming to clear them. They're not coming to buy all this stuff, even if businesses shelter them from the extra cost. That's a weakness in the consumer that matters much more to what happens with GDP than swings in inventories this way or that. If consumption really is unraveling, as the first quarter data hinted it might be, that's the real concern.
I think so. What if let's just go to like the the most simple way to boil down sort of a macro view on the world is what is your view on growth and what is your view on inflation?
Sure.
And if, let's say, GDP is north of 2%, you're currently in an environment, and I know I'm looking at a very short window of time, and the market is a discounting mechanism for 9 to 18 months in the future, but just go with me on this. We're in an environment where growth is accelerating. And I think you and I are both of the view that inflation is not necessarily, I'm not as spooked about the prospects of inflation in the short run as it seems the markets are. It seems you're in that camp as well.
And I don't think the markets are either.
I agree. I think there's a narrative
I think the markets are not nearly as afraid of inflation as, let's say, the Fed is.
Correct. Correct. So if you and I have this view of, decelerating or disinflation, let's call it disinflation, and accelerating growth.
So I don't share that part of the view.
Okay, let's break it down. But let me just finish the question, just so the audience understands the premise. That's a pretty decent risk-taking environment.
No question.
When you have accelerating growth and decelerating inflation, regardless of the narratives, at its core, that's a solid risk-taking environment from a macro perspective.
Yes.
Tell me where your view then breaks down from that.
We don't see either of those things occurring. Inflation is not decelerating, it's accelerating. I just don't think the markets are worried about it because they're looking further ahead.
And real quick, as a caveat, if that were true, accelerating growth and accelerating inflation is also a good risk-taking environment for equity assets. Just as a quick backdrop for the audience. Go ahead.
Yes.
So that means everything in your perspective, it must hang on a cratering, effectively, of growth.
Which we just saw in the ISM numbers last week. And which we've been seeing in leading economic data, let's say since the beginning of the year, certainly, but having already seen first quarter GDP numbers, let's look forward since then also. So the U.S. economy is about 70 to 80% service sector. Last week, ISM told us that in May, we saw the first contraction in the U.S. service sector since April of 2024. Now, you'll recall there was a growth scare coming out of the second quarter going into the third last year, where the Fed was reluctant to cut rates because they were still looking at a little bit of a reflationary pop in the first half of the year. And the markets were screaming at the Fed, you're going to be late. There's a growth risk gathering here. So, and that's how the markets talked themselves into rapid rate cuts that the Fed then had to deal with when they got ultra dovish in September, though by then it was too late, and the Fed did this kind of judo maneuver where essentially rather than fight the markets in their dovishness, they gave them that and more to kind of reset speculation. And it was very effective. But all of that came out of there being a growth scare and the Fed being reluctant to act on it. We have a very similar set here. The PMIs have been telling us that growth is near standstill when you look at the S&P global numbers. They warmed up a little bit in May, but the trend since the beginning of the year is unmistakable. It is a steep down. Economies, like markets, don't move in straight lines. There's an ebb and a flow. But the trend is very much from the fastest growth in 4 or 5 years to near standstill. The ISM numbers agree. But most important of all, when you got the initial growth scare at the beginning of this year in February, the S&P 500 and the break-even rates in bond markets, the expectations for inflation, they turned down in almost perfect lockstep. And they continued to go down into the lows in April. Altogether, 5-year break-even, 10-year break-even, so the liquid ones, and the S&P 500. And that was a really clean narrative saying we got an economic slowdown coming. When demand falls away, that's disinflationary, so the Fed's going to cut rates, dollar's going to decline. This is a sign of weaker growth. All the usual things that happen in an economic downturn. Since April, stocks have very clearly recovered, pretty much back to where they started. They're back to the site of the breakout. Break-even rates have not. And this is why I say that the market is not concerned about downwind inflation. The markets are concerned that what the tariffs will do is hurt economic growth. And indeed, that whatever is coming, and again, assign your favorite reason for an economic downturn. Ultimately, that doesn't matter. What the markets are telling you is they are anticipating a disinflationary environment, let's say 5 years forward, and that's emblematic of there being less demand, less of a pull on prices. So that's telling you that there's an economic weakening of some kind that the markets anticipate, that stock markets have now decoupled from. So it's not like the markets don't see the economic downturn. They do. And if now you get in the near term, we're about to see CPI data in less than a day here, less than 24 hours, that's going to, if it comes out as expected, give you the highest inflation headline and core in 3 months, well, that just tells you the Fed isn't going to respond to whatever economic downturn the bond markets see. And that's not a happy recipe for risk, provided risk decides to care.
So then let's go with your premise. Let's go with your premise that the economic picture is deteriorating, and for whatever reason, stocks are not appropriately discounting it.
Yes.
Let me then try to make the case for why the nominal price of equity assets may not need to discount to the extent one would think. So the first is that a Republican administration with the trifecta is on the verge of pressing through a bill that will add trillions of dollars to the deficit. And that money goes somewhere. It's going to go into the real economy. So in the same way we had 2 quarters of declining GDP during the Biden administration, and people will say, yeah, but it was a funky time. It was reopening. GDI was higher. I'm just saying that you had a period of declining GDP, but you also had sort of this fiscal response at the same time, which seemed to stave off what I think a lot of economists had called for, which was a period of slowing growth, slowing consumption. It just didn't happen, and if it did, the market and the media looked through it. Mm-hmm. So it seems like we're on the verge of getting that same thing. You're on the verge of dropping corporate tax rates even lower. You're on the verge of unless the Senate pulls a Superman, unless Thune pulls a complete Superman and starts to wear a cape and says, I care about America more than partisan politics. But I don't know that I'd put all my eggs in that basket. The second reason...
I don't have any eggs in that basket, to be perfectly honest.
Second reason is
that by the way, doesn't, like, that's either side.
Right, I agree. We'll get to that later. The second reason is that same bill raises the debt ceiling by an additional $4 trillion till post the midterm, meaning there's some additional bullets in the chamber in case they need to be fired without having to go through the whole negotiating rigmarole that they normally would. And again, they're going to hold that trifecta into the midterm. So I guess what I'm saying to you, Ilya, is maybe I start seeing some softness in PMIs. Maybe I start seeing some softness in ISMs. And maybe the market is even wrong about a GDP number that is north of 2% in quarter two. My question to you is, with all of that money locked and loaded in the chamber, why should I not be looking at that as my equal but opposite offset to any slowing growth environment that we see?
I think you have to look at this environment, touchy as it is. We're seemingly at some kind of an inflection point for the economy. We're seemingly at some kind of an inflection point for inflation. We're seemingly at some kind of inflection point thereby for Fed policy. And we're certainly at some kind of an inflection point for fiscal policy, as we have sort of the tariffs kind of work out what they ultimately look like, maybe. We have the fiscal side domestically with this spending and tax bill working its way through Congress. We're obviously at some kind of a spot where the knob is going to turn, and it's going to turn this way or that. And the markets kind of reflect that because we've reset back to essentially where we started the year, which was this consolidation range that began forming in early December, where the markets kind of ran into a high. We still haven't cleared that high from then, and said, okay, now let's see what this is. This is fair value until we know what this is. And since then, we've had a scare where it seemed like the fair value might be much lower, and now we've come back to essentially where we started. So we're clearly at some kind of we're at some sort of a near-term equilibrium waiting for something to happen this way or that. And so I think in this environment, you have to be very nimble and flexible. If the narrative you paint works out as advertised, you could have a lot that the markets take from that and go, okay, we're in the clear. There's a lot to be said for the markets in such an environment becoming increasingly, let us say, dismissive of the noise and saying, sure as anything you might think, 48 hours after whatever crazy headline, there will be one in the opposite direction. So should we really pay attention? Or is this just deadlock? And it's the kind of deadlock that we like, albeit louder. Because markets ultimately would love it if politicians did nothing at all. Because then expectations could be anchored and the markets would not have policy risk. And they could only just look at economic indicators within a fixed framework of deadlock and say, okay, well, at least this is a little bit more predictable. So
the only people reading headlines at face value are the people who like to lose money.
I agree. Nevertheless, those headlines have shown themselves to have impact on markets.
They've created variance, volatility, and opportunity for people that read through them to the real card game that's taken. I
agree. But how much volume does it take to move the S&P 500, the world's most liquid, biggest stock index, the way it's moved between mid-February and the beginning of April, and then to flip it back the other way? That is a ton of money being reactive to the noise.
Yeah, that's great opportunity for people like me who don't have a risk manager tapping me on my shoulder.
Well, that's right. But that's neither here.
Like somebody at an institutional desk. I'm just saying, like.
No, I agree with you. My point is.
Go ahead.
Yeah, my point is that you're at this inflection point here where you can take for granted that you can look forward, but chances are you can't. Chances are you can't over extrapolate. And so maybe you get the tax bill and maybe it offsets what is now a tariff rate that's increased fivefold. And that even if the pauses are made permanent, is a major hit to growth.
I don't think it will be. I think the market I think the market was totally fine with 10%. I think all of the smartest people I listen to talk, I think well before this went into play, they already saw 10% coming and they were comfortable with 10%.
That's perfectly fine for the markets. The question is, are consumers comfortable? Because if
same thing,
and this to me is the biggest thing. I think the single most important thing to watch now is what consumers do. Because forget the noise. Forget what the markets think. If we continue to see, like we did in the first quarter and like we're starting to get hard data on into the second, that the consumer is retrenching, then nothing else matters. Because that's 68.5% of the economy.
Here's what part of me hears what you're saying, and I totally agree. Then there's another part of me that goes, business is not as dumb as it used to be 20 or 30 years ago. These businesses have some of the most sophisticated analytics. They have some of the most sophisticated predictive purchasing platforms. And yes, they did get a wrench thrown into all of their historical data, and I'm pretty sure it's tough to run some of these models, but they also at the same time have AI that's growing in sophistication. My point to you is, if Walmart, for example, gets any whiff that they can't push this stuff on to the consumer, they don't push it on to the consumer because they understand that they would decrease their demand at the end of the day. So the demand curve shifts here, and it is very possible that you're right about asset prices, but you're right for a different reason. You're right not because the consumer slowed down. You're right because corporations realize they anticipate not being able to pass it on to the consumer. Therefore, they take it into their profit margin.
Well,
and I
we've
think
seen that happen already.
Yeah, I think that's the thing that ends up being a weight on asset prices, and I don't think many analysts. I don't think that shows up in the current PE. I don't think many people are really factoring that in.
Well, that may be so, but it's basically saying the same thing, but plotting a different reaction function. Where you say
think that's fair.
Where you're saying, well, why can't they pass it on? They can't pass it on because they see that the consumers won't eat it. And if the consumers won't eat it, then the consumers are weak. Then the thing you need to be worried about is
because weak consumption data won't show up. You get what I'm saying? That's the difference.
But it's already
showing. In my scenario, you'll get earnings calls where people, and this is the thing I love about you. We can be arguing the same damn point with like this this very interesting line of nuance. In my world, growth numbers and consumption numbers don't actually slow down. They stay constant, if not grow a little bit. But the offset is a profit margin that can come in. Now the offset to the
I can see that.
But then here again, there's all these if then that's.
No, exactly.
So then, then the way you ease that is you gave everybody cheaper corporate profit margins. So you're not even really going to see that either in the data because you're going to get a lower corporate, not profit margin, a lower corporate tax rate. So you're going to end up seeing expanding corporate profit margin anyway in the data as well in most of these corporations, giving them a lower corporate tax rate.
That might be why they're choosing to eat the tariff hit for now, because that much you do see. In fact, in the April PPI numbers, you saw that they took a 1.6% haircut on margins, which, by the way, for a single month, that's a lot. They took a 1.6% haircut to essentially insulate consumers from passing on what were some of the fastest input inflation, core, cutting out energy and food, basically in a year. And if you erase the errant spike in 2023, which was a April 2023 1-month one-off, the fastest input inflation going back to early 2022 before the Fed's hammer really did what it did. So we're in a situation where it's not like the risk that the tariffs will be inflationary isn't being realized. It is. It's just businesses are eating it. And maybe they're eating it because they're expecting a tax cut to offset it. Maybe they're eating it because they think that the tariffs are a taco thing and they won't stick. For whatever reason, they're saying we're not going to take the bet that we're going to pass this, or at least not as of April, that we're going to destroy demand by passing up these prices on. We're going to keep our consumers. We're going to eat the difference because either it won't be lasting or we can swing it. And maybe that continues. But the PMI data more recently for May suggests they've started to pass it on.
Mm-hmm.
So we'll see.
We shall. We shall, my friend. If the tough part about even my proposition right now is that at 6,000, a lot of what I'm saying is in the price already. Exactly. So there's not much upside to even my point of view here. And that's, that's the sick part about the markets is they put the line exactly at where half the market's going to take the over and half the market's going to take the under. Real quick, I want to show you Schwartzman's a comment from earlier today. Yeah. He said that the tariff situation will resolve itself in 6 to 9 months. So Schwartzman of Blackstone.
Yeah.
And I think Bill Ackman had said something similar at the beginning of May, that he was looking around the corner to a likely resolution with Ukraine, with a likely resolution to a lot of the tariff volatility. And it seems like more and more the market is looking at this as what it was to begin with, which is a creation of negotiating leverage to then be walked or talked down. And I'm not sure, that speaks to the complacency, right? The VIX is at 16 for a reason, because there is complacency. Yeah. And valuations are high for a reason. Maybe you can make an argument that valuations as a whole, Ilya, are not that high. It's really like a handful of companies, like probably 4 companies that have really pushed this market up to these extreme levels. And the individual company does not have these staggering valuation levels. And you can find some values, especially in small caps, but the market as a whole, as price as a whole, is trading with a pretty dumb multiple. What would you say to that argument, that there's value to be had? It's just not at the index level.
I think there's always value to be had on sort of one-off things, even in the midst of the worst possible recession you can imagine, short of a complete Armageddon-level devolution of the financial system. And in those environments, your worries have nothing to do with investing and everything to do with canned foods and ammunition. So you can't have a trading thesis around Armageddon. In Armageddon, your trading thesis doesn't matter. Any trading thesis doesn't matter. Trading doesn't matter. So when you're looking at any given environment short of Armageddon, there will be those names that stand out. I think that's a non-controversial kind of a thing. To me, at the index level, when you go back and you say, well, we've learned that the tariffs are negotiating leverage. Well, I think we went into this year with that idea. If you expect that the tax cuts and deregulation is coming, well, you went into the year with that idea, which is why you came into the year near the highs. The markets didn't react badly to the election. They reacted with the idea that what the election will mean is some amount of tariff back and forth that isn't overly scary, and a pro-growth expansionary fiscal policy, more generally, that favors no meaningful reduction in spending, but brings tax cuts and deregulation, and that this will be generally a positive thing for near-term growth. It's only right that the markets are back to where they were when this was consensus. The question is, have we learned anything different between then and now? And the answer is, my God, yes. Have we learned other things? But
I would argue, though,
yeah,
the market was probably, I don't know, maybe not. I think the narrative that I understood, the administration was going to be pro-growth, pro-business. Yeah. But I also had no idea they were going to open up the deficits by the scale that they're going to open them up, and that they wanted to increase the debt ceiling by $4 trillion. That wasn't in my discounting window. I didn't have that anywhere close. I didn't think they were going to close the $2 trillion deficit on day one. I thought that would be irresponsible. Extreme austerity would do the opposite of being pro-growth. But I had no idea. So in some extent, I underestimated how serious they were, how far they were going to bring the tariff situation. But I also underestimated how, in my personal opinion, fiscally irresponsible they would be at the same time. And to me, at some level, those two, I don't know if they're exact offsets, but they are on the opposite side of the scales for sure.
They are. They are on the opposite side of the scales. To me, what all of this kind of boils down to is the markets were broadly optimistic, and we're back to the levels where they were broadly optimistic. But the implementation piece, since the time the administration took office in January up through now, be it on the tariffs or on other things, it has left a lot of people, even that supported the agenda, wanting.
All right, let's make some people mad. Tesla was up 5.67% today. We're back to 326. Yeah. Last week, when they were going through their shenanigans, which is basically what I want to hear your take on those shenanigans, and then the follow through, what you think it means, if anything, for prices, and what you think it means, if anything, politically. I said, I believe it was last Thursday when this was down at 285. Yeah. I said the odds favor taking risk in Tesla, and they favor a likely truce between the two for various reasons, which I broke down on Thursday. You're more than welcome to go watch it. It turned out to be even a broken clock is right twice a day. It ended up being at or near the bottom here, and we've rallied for 3 days in a row. Who knows? Maybe we go back and retest those lows. Maybe they say something crazy. Maybe they do cancel a Starlink contract. But the president has walked that back, and it seems like Elon's walked a lot of his stuff back. I'm interested in this mostly from the perspective of the risk takers out there that are taking bets in Tesla right now. But I think there's also a political overlay to this as well. Tell me what you thought about those shenanigans, and tell me what you think about what's happened since.
You and I talked on the show before the administration even took office, before the election even occurred, that the having of Elon Musk and Donald Trump in one place was a short-term kind of a thing, because both of these guys are sort of notoriously single-minded, confident in themselves, convinced that what they think is the right thing, and before long you'd get to a place where they'd have a different idea about something. And since neither of them take kindly to disagreement with what their perspective is, it's only a matter of time before the kind of the ego clash would happen, because they're both this type of character, this kind of all-dominating, everything must follow as I lead it type of characters, and they've been that in their various organizations, kind of singular individuals behind which everything falls in. They set the tone, and they're not in the business of being told no or you're wrong, and that those personalities would eventually clash. We've now seen the clash. I don't think that should have been unexpected for anyone. I think it got kind of particularly nasty at spots, but I think cooler heads are prevailing in the sense that Elon has been clearly explained, it seems, that lots of his money-making machine depends on government contracts, and whatever he thinks about his future political ambitions, he won't be able to finance them if he breaks the money-making machine. So better not to do that. And I think the president is comfortable kind of sitting back and having looked like, Elon who? What? I don't care. Whatever. I think that's a posture that works for him and allows him to kind of maintain sort of a sense of being above the fray and not getting into it, and at the same time not compromising incredibly important things that Elon universe companies provide for the government and for which there is no alternative. There isn't another vendor that's going to take the place of SpaceX in a hurry, let's say. So, or Starlink. So with that in mind, it sort of serves both of their interests to have a détente and try to say as little as possible about each other for a while. I think if you want to be a longer-term holder of Tesla and you thought that this episode was nonsense, which in my mind it was, then you don't expect it to have any kind of meaningful influence on the future of the company, and so you saw a buying opportunity. I think if you were like you, a tactical sort of participant, and you saw the sell-off and said, this is probably not nothing, that was an opportunity that made sense. I think when you look at the thing now and you say, well, who am I if I look at the market now? If I'm a long-term investor, this thing is still on discount relative to where it's been, and all of this nonsense doesn't mean anything for the long-term prospects of the company. So if I'm going to buy some Tesla, stick it in the portfolio, and the next time I think about it is when it breaks a big level or dips a bunch again. And otherwise, I'm just going to accumulate it for the long term. This spot still makes sense. But if you are a trader and you live in, let's say, the normal tasty 45 DTE kind of world, you're back to where the range was, where fair value kind of started to get stuck at, let's call it 360 to 350, and you were in that range for a while. Then this news cracked the range. You're back to the underside of the range, so you're essentially testing former support as resistance. So from a risk-reward perspective, would this be the place you now buy? I don't think so. You need either a pullback or a breakout to reset risk-reward from a trader's mindset. From an investor's mindset, the discount, I think, still continues.
Yeah, I think I think there's leverage on both sides. I think, to your point, I 100% agree. Elon knows where the bread is buttered at its highest level, and that's being able to suck at the teat of the treasury. And there is no source of liquidity greater or bigger than that. And I think on the other side, I think Donald Trump knows that Elon has a lot of money, and that money translates to political power. He's got a big voice and a big platform that can translate to a meaningful hit in political favorability. And for that reason, I think he took this sort of approach to somebody who aggressed him in public that I've never seen him take this approach. You know, you could say it's calm, cool-headed, it plays for him or whatever, but like, to me, that's something outside of his patterns that I've ever seen him at. I've never seen him act like that before to somebody who was that aggressive to him in public. So unless this is some like grand opera strategy of allowing, you know, I think Chris has mentioned this before, allowing Elon to sort of pivot away from MAGA a bit from his own personal brand. And this is all just sort of political theater. Unless that's the case, it seems like what played out between them is sort of an acknowledgement of leverage for and from the other person on the other side. I agree. I'm long stock, so this isn't even a 45-day thing for me. I'm long stock. I owned some like 305 puts to the downside, so I was kind of okay. I want to say it was okay. It definitely did some damage to the gains that I had in the long stock, but I was sort of okay with variance and volatility below 300. And I think I stay here. I agree with you. I think we could top out here, and the short-term move could be over from a trader's perspective. I agree with that. But as a little bit longer-term hold, I'm okay holding this. Yeah. I think you want to see signs, though, that the administration is not changing its stance on sort of the robo aspect for Elon. As long as Elon can walk this back far enough where he's still going to get, I don't want to call it preferential treatment, but he's going to get to move along his robo part of his business in Texas and other parts of the country, I think you're okay. But if you see signs that that's sort of being put on ice, that's not good, because as Katana said, Tesla might be a little bit overpriced for its actual sales, which we saw, I think, what was it, this week or last week, the automotive sales. And I think that's true, but I think the market has started to price robo in the distribution of how you think about Tesla. And I think that's why they probably are getting more favorable valuations. And as long as you can keep that in the distribution, you probably have got a nice little carrot to keep chasing.
Yeah, I kind of saw the blow up as almost a kind of crescendo on the Elon is taking his eye off the ball story, and now that you've kind of bookended that story and everything has gone quiet, I think that's ultimately good for Tesla and sort of raises the risk that they pull some rabbit out of a hat.
Yeah, it's also
because now his ego is on the line.
It's also probably smart. I wouldn't put this out. Elon thinks like a robot. It's probably smart to put yourself out of the public ire going into June 14th, this sort of national day of no kings protest across the entire United States. I'm guessing if the LA riots are, I don't know if people are calling them the LA riots. I guess that's what I see. The LA protests are some indication of what. If there's some indication of what June 14th could potentially look like, I'd create the most separation I possibly could between Donald Trump and my business. If they're setting Waymos on fire, I tell you what, if you're having Teslas are a lot easier to get your hands on than Waymos.
I tell you what,
throughout the country.
We were having this conversation with Chris and Dylan on overtime today. I see them setting Waymos on fire in LA, and that actually makes me think that like Waymo has arrived as a kind of symbol zeitgeist thing. That crazy people are making it a point to turn a burning Waymo into a symbol of something. Makes me think that here is a company with a bright future that has a good product that is going to win. That is going to win
Google,
the self-driving wars. It's a Google thing, yeah.
Yeah, and I mean, if you're giving them the benefit of the doubt, I think Google has been sharing data that helps ICE in their endeavors, and so the whole thing against Waymo is really a move against Google. I'm not justifying it. I try to give people the benefit of the doubt, even though I think the actions are wrong. There's the logical connection between, if I don't like Google, well, this Waymo entity is a representation of Google. Whatever. Any quick thoughts? I tried to talk about this
how many
at the end
people
of my
Googled how do I order a Waymo so that they could set it on fire.
I tried to talk about this at the end of my show. Again, we're probably going to lose some people on this, but I tried to talk about it at the end of my show yesterday, but I was too drugged up on cough medicine to make any sense on what I think I was trying to say. Do you have any quick thoughts on what's going on in your home state?
I'm thankful that it hasn't arrived in San Francisco, though we've had anti-ICE protests here. They have not become the sort of thing that we're seeing in LA. Obviously, I think it's absolutely idiotic to burn down your own city as resistance to a crackdown that will only become harsher as a consequence of you doing that. I don't think you do anybody any good by setting your own city on fire, by looting stores, and otherwise terrorizing your community. I don't think that gets your message to a good place. I think it gets it to a bad one. And what's going to happen is there will be a harsher crackdown. And to the extent that there is then another kind of series of episodes nationally, like what we saw with the BLM movement during COVID, where the entire country seemed to be trying to quell some kind of a pocket of something. I don't think that kind of unrest is helpful. And I think it feeds into a retrenchment in the economic cycle type of narrative. I think you start to accumulate things where people start to get defensive generally. The bed and breakfast I was at in the Redwoods this weekend, I was talking to the owner. You'd think, talk about a business that is as far away from tariffs as possible. This is literally a small property off the Russian River, relatively nice, pretty expensive because there's not a lot of properties like that in the area. You'd think here is a thing that is about as removed from worrying about widgets made in China as you could possibly imagine. And the guy is saying, you know what, as soon as the tariff news hit, my bookings were cut in half. And it's because the optics matter. And if you get inflation is rebounding, the country is riven with unrest, tariffs, wars, these are not good optics for risk taking. Never mind by investors, they're not good optics for risk taking by consumers. And if consumers retrench, that's the game. So I think this
only you
riot
could turn the LA riots into a negative risk taking somehow linked to negative risk taking.
I think they're a terrible idea. I think none of this is any good. That you see rappers from LA coming out and going, "What are you all doing? Why are you burning our own city?" Beware gaslighters that want to incite a steeper crackdown. I think when that's the response, you should take heed. But aside from kind of the social element, I do think that the optics of this have consequences consequences. And if it spreads, those consequences will be bigger.
Man. Okay. My quick thoughts are, and probably a bunch of people are like, we want to hear your thoughts on risk taking, not necessarily these types of things, but I don't know.
I tied it.
I sort of believe, I think important issues of your time, I think you're a coward if you run from those issues, if you have a platform to speak of them. And so to the extent possible, I'll try not to avoid difficult issues and at least give a few minutes on some of these topics. My thing is, I don't necessarily agree with the spirit of the protest to begin with. I think if you sort of, I'm not anti-immigration, I'm pro-immigration, but I'm pro-legal immigration with some sort of meaningful and fair process that manages the labor supply and the wages that people get paid, but it also manages the uncertainty that an immigrant who risks it all to come to a better life in America, that they get certainty once they cross that border. I think we owe that to the U.S. citizens, and I think that we owe that to anybody who aspires to be a U.S. citizen at some point. So this general spirit of the protest I disagree with because, I think illegal immigration is illegal. That said, I'm disappointed, that over the last 5 or 10 years that we as a public haven't learned anything about how to display or how to meaningfully move the needle when we are dissatisfied as a group with some political issue. We've not learned that these displays, they actually have never created a beneficial outcome.
Yeah.
And I think the definition of insanity is when you keep trying the same tactics expecting a different outcome. And that said, even if I don't agree with the general premise, even if I don't agree with it, the one thing I would say to everybody is like, God, man, like, have we learned nothing in history from civil disobedience? And whether you're on the side of a nonviolent movement like Martin Luther King, or whether you're on a more aggressive show of force to better your own communities like the Black Panthers in the 60s, this is none of that. This is none of those things. And I think we have to, the public, we have to be smarter about the way that we organize. And at some level, if you don't understand, if you don't take a moment and go like, hey, why is the Walton family funding this gigantic organized protest on June 14th? They're pissed at the tariffs. Like who ultimately benefits if we start lighting our own neighborhoods on fire? You know who benefits? Palantir is going to get private contracts to restore order, or other military contractors are going to benefit. You're not going to benefit. You're not going to have a better outcome. And I think like at some level, we have to get smarter about political organization in this country. And I don't see that happening. I don't see us getting wiser. I don't see better leaders. I don't see stronger plans to mobilize people who are frustrated and disenfranchised. And again, I disagree with the whole point and premise of this, but even still, this isn't the way, man. This is not going to do anything positive. It's only going to create more negative outcomes for the same group of people who are protesting, and I don't know how we don't see that.
You and I are in total agreement.
All right, man. Let's transition to the dollar. I'm just kidding. 110,000.
Gold is down 10 points.
Yeah, the Nasdaq's down 2 points. That's like that. That's the that Chappelle line from Killing Them Softly. The Nasdaq's down 2 points. Bitcoin 110,000 staying around. I don't want to do the whole Bitcoin thing with you today, though you are wrong and it is going higher. What do you think about it?
I'm not even debating that.
Tell me how to think about the dollar relative to the basket of currencies here: the euro, the British pound, the Aussie dollar, the yen, the CAD, the Mexican peso. You don't have to do all of those, but just take any one that makes sense and let's go into it.
Well, it's a good thing that I think basically the same thing about all of them, which is that I think the dollar is weak here, and has room to weaken further. I think it's kind of been in a digestion mode after a period of weakness, but whereas stocks have clearly rebounded from their April spook, bonds have clearly steadied. We've seen signs of kind of normalization across the board. The US dollar has never really rebounded. It had a little bit of a pullback. It's reset to its sort of lows from early April or thereabout. We have it here in the euro. We can clearly see the high there was just over 116. We got as low as about 111 on the correction, and we're back to 114 and change. So I think the dollar is telling you a story here, and despite the fact that I've been more bearish on equities than the markets have validated,
That's the most that's the smartest way I've ever heard somebody say that what you're trying to say.
Since April, because I mean I was bearish in the first half of the year, and boy did the markets validate it. I mean they absolutely did. I then was long off the April lows, and the markets validated that. I just got out way too early. I basically was in there for like 2-3 days. But the dollar has been the idea that's worked. I've been short basically all year. I remain short. I've taken things off and taken things on, obviously, as the markets ebb and flow, but I'm back to basically a full boat loaded long euro, pound, Aussie, CAD, on the spot side, yen and Swiss franc. So I'm pretty loaded anti-dollar here, and I think it's difficult to take that view right here, right now, just because you're kind of near where anti-dollar resistance is. So you're near resistance on the euro, you're near resistance on the pound, you're near resistance in a lot of these things, Aussie dollar, CAD. So it's difficult to initiate right here, but if you haven't initiated, there'll be, I think, an interesting spot to do that here before long, because I think what all of this kind of comes to, maybe even in the next 24 hours, because we have this CPI thing, is the market goes, right, we think there is a growth downturn and we should look through these higher inflation numbers, but that's not how the Fed is going to look at them. They've made that abundantly clear. And the fact that the president is, in a less than factual way, berating Jerome Powell again, that suggests that they're going to be even more resistant at the Fed, because they don't want to look like they're kowtowing, because so much of their effectiveness depends on the markets taking them as credible. And if they look like they're another arm of the fiscal policy apparatus, well, then they're not credible. So
I'm not sure if that works against Trump's goals. I think if I don't know, this is the way I see things. Sometimes I'm a crazy person, trying to find too much between the headline and at face value. But the way I see it is, the Fed is clearly from the outset throwing on a resurgence in inflation. They're putting that, and any slowness in the economy, they're putting that on Trump, and Trump's trying to put any negative impacts back on the Fed by saying they're too late. So I see two entities that are both probably partly responsible. They're both pointing at each other saying it's his fault, it's his fault, it's his fault.
Yeah.
So that's kind of, do you see the same thing happening, that the Fed is pointing all of the uncertainty, all of the potential negative impacts of raising interest rates, leaving it here, not being responsive to what I think the market has been asking for? They're putting it on these tariffs, and the president's pointing at them saying, you're always too late and you're making the wrong move here. They're basically trying to scapegoat each other. Do you see that?
I see the Fed's point more so than I do the president's, because the president is who's driving the tariff policy. The Fed doesn't have any influence over that policy. I think when you say I am going to increase tariffs fivefold, and I'm going to increase them in this kind of stutter step on and off, on maybe, off maybe, this level, that level, tariffs on China are 145%. Now they're 40. Now they're back. Where are we now? So I think when you do that and you are the impetus for it, it's only natural to go, well, if you're the impetus, if you're the one making the decisions, then the buck stops with you because you made the decisions. You're the executive. It's your policy that you're rolling out. I think from the perspective of the Fed, they're always reactive as a function of what they do. Their mandate calls on them to be reactive. This is why they look to target inflation in the medium term so that they're not all volatile and jumping from rate hikes to rate cuts too quickly. This is baked into the cake for them. I think for them to kind of point a finger at the administration and say, we don't know what this will do. They're not saying this will be bad and it's the administration's fault. They're saying we don't know what this is. But with the unemployment rate at 4.2% and inflation not running away, let's say north of 3, we have the benefit of pulling back and going, let's see as much data as we can see until events compel us to act. I don't think that's unreasonable.
Don't you think that can play in the administration's favor as well? In other words, if I goad you into saying, you're too late, you're not going to move, you're a chicken, and then it's the same taco thing, but it's in reverse. So, you go, I'm not going to move rates. And by not moving rates, which you had implied you were going to do 4 times this year, by not moving rates, what could that ultimately do for your borrowing costs, which you yourself...
Go ahead. Yes and no.
Go ahead.
You didn't say you were going to do it 4 times this year. In December, you said you were going to do it twice this year. And now the market is on...
Yeah, that's true. That's true.
And now, and you reiterated it in March. And now the market is saying maybe you're going to do less because you're only 50-50 on that second cut because inflation seems to be perking up, at least near term. And what the market now seems to be saying is we only have 39 basis points priced in through the end of the year, so we get the one cut, but then the next one, who knows? It's about a 56% chance. I expect we'll get it, but that's me. My sense is that what all of this boils down to for markets is, no matter who's pointing a finger at who, is the market is telling you we didn't rebid break-evens up because we think that inflation isn't a threat over the medium term. We think you should be cutting. And the Fed is saying, we're not ready, we're not ready. And what that will do is it will push the cuts into the back end of the curve, as we've been talking about, and amplify those cuts. Because the market is going to say, you're going to have to cut, you're going to wait longer than you should, the economic downturn will be more painful because you'll allow it, and you'll need to be cutting more aggressively later. And that what ultimately this does, to circle all the way back, is it gives you a weaker dollar, it gives you higher gold, it gives you higher long-end bonds, and I suspect lower stocks.
I don't know. Some part of me thinks I get the spirit of what you're saying. I don't know that the market is saying you're gonna need to cut more later.
You're kind of starting to see it. So
I think the market is saying you will get a response, but there is a possibility here that the Fed puts the irresponsibility on the fiscal authorities, that they say we're going to refuse to be irresponsible. and that we're in a period of fiscal dominance instead of sort of monetary easing. Don't you think that's a possible outcome here?
Sure, but I also care much more about what the market is actually pricing in than narrative making. In the sense
I don't understand why you think that's the case, because the two-year yields have actually been climbing higher and higher.
That's exactly right, which speaks exactly to what I'm saying. If you look at what
the
is
opposite.
No, not quite. The 2-year yield reflects expectations for near-term policy. If you look at what's been happening with what Fed funds futures are pricing in for this year, since the beginning of May, you have a move from having 100 basis points priced in for this year to now 39. At the same time, you have a move in the pricing for next year that went from 25 basis points to 52.
No.
Yes, that's what Fed funds futures are showing you.
No.
Yes.
I'm telling you, there were more cuts priced into 2026 at one point. They've gone down to 2.
They have gone up since April the 22nd when they peaked, and so you now have 52
but bro,
versus
your total,
25 basis points in cuts.
Your total statement, it would in order for you to be right, the total amount of cuts would have to go up, and I'm telling you they've gone down.
The total, well, that depends what your reference point is. The total number of cuts have gone down
end
since
of December
early
26.
April. The total number of cuts between this year and next has gone down from the peak, holy moly, in early April. That was 137 basis points. I know it's specific because I'm looking at the numbers.
I trade this stuff every day.
I mean, I'm looking at the numbers right now.
I know, and I'm telling you, the 2-year yield has gone up from 3.85 to 4. They're not backloading more cuts in the 2-year. They're taking them away, and you've gotten less cuts from now until the end of December 26 at 4 than we had at one point earlier this year, which was 6.
The 2-year
there was at 1.6 cuts priced from now until the end of 2026. There's now 4.
2-year Treasury yield is
Jesus. You're serious, bro.
Of course I'm serious.
What is the 2-year to you?
I don't disagree with you on the direction of the 2-year. What I'm disagreeing with you on
you're disagreeing with me with the number of cuts over the next 2 years. That's what you're doing.
And that's not what the 2-year rate specifically represents. But if you look at Fed funds futures, which literally represent in 30-day increments what the Fed funds rate will be.
Dude, the curve is flattening, my man. They're saying less cuts on the front end, and they're not moving that.
That's right. They're saying less cuts on the front end and more cuts in the back end. Yes. Right. They're saying fewer cuts this year, more cuts next year. And the total,
think we'll have to
your
agree
point,
to disagree.
To your point, the total number of cuts
somehow
has gone
that
down
means the total
relative
cuts
to
has gone
early
down.
April, but since early April, but it has gone up since.
All right, let's make this more interesting. Let's make this a more interesting
mid-May.
conversation. Let's make this more interesting because you and I might be starting with different starting points. So I say we've gone from 6 cuts from now to the end of next year to 4. To me, that's
over
less,
what
but
period
that's just
of time?
Correct, and that's where our
over what period of time? Because I agree with you if you start in
the last month or two. In the last month, as I've been watching this thing. So here's where I want to go.
I would say in the last 2 months, yes.
Okay, here's where I want to go. At 39 basis points. I like to play the over/under game, and I said I thought we would get to 25 basis points, which is why very early on I went short the 2-year. And it worked out. I didn't ride the whole thing. I haven't been squeezing out this last little juice of the lemon because I don't think it's worth the risk and reward. But I said once we got to around 1 cut, I thought that might be an interesting point to start fading. You know, because Either you have to believe that the Fed's going to get to a position where they're going to have, and now keep in mind, they did cut already 75 basis points from what they said was neutral. So
which is why I took issue with the president's command of the facts, because he was out there over the weekend saying we haven't cut at all and the ECB has cut 10 times. Well, no, the Fed cut the equivalent of 4 times last year.
Yep, totally fair. So I wonder, Ilya, versus us arguing about the 6-4 whatever. Let's just what is our bet going forward? Where do you think the most interesting bet is here? If you were going to bet either SOFR, if you want to talk SOFR, or if I like to bet the 2-year as a proxy. I think in most times it's directionally accurate and I get more liquidity and there's a bit more volatility. So I like the 2-year as a proxy of betting Fed policy. You can choose whatever you want. What would you bet
I like
right now
the dollar as a proxy for Fed policy near term, but for me, the bond market bet is not at the front end. It's at the long end. I'm with you. For me, the bet in the bond market is at the 10-year, at the 30-year. And so what I actually like is being long the 30-year here.
And that's based on what do you think that transpires that makes the 30-year an interesting bet?
I think we get fewer cuts up front. I think the market starts, just as it did last year, pushing more cuts out along the timeline because they're going to say the Fed is going to be late and therefore will have to do more, because it will have to catch up to a recession that it will have allowed to progress deeper than, let's say, normal. And what that will mean is that the long end will see speculation of deeper cuts later. I think that's also a reason why gold is going to perk up. I think it's why the dollar is going to continue to get sold. To me, that's one idea. Being long bonds and short the dollar and long gold is basically one macro kind of thesis here.
Yes, I agree with that statement. So long as the existing correlations hold up, I totally agree with that statement.
Yes.
I guess I just see it a little different. Like the way I see it is not, I think it's the pushing and pulling of rate cuts that I don't necessarily think is always true. I see if the Federal Reserve holds rates, they're preserving purchasing power, making the long end a more worthwhile bet because you believe you have a responsible Federal Reserve, but that lowers your growth prospects and your inflation prospects over a longer period of time. And the more duration risk you're taking, the more sensitive that risk seems to be, at least right now. So I guess I just see it a little bit different. But I don't know that it really matters. I think at one cut, I don't know that the Federal Reserve has got it in them. I'd be really surprised. I kind of want to see that world where we're actually talking about raising rates and they use Jackson Hole as this pivot moment to get back to neutral where it's 50-50. It could go up or down. I'd love to see that world. And I think I would love to trade that world. I'd love to trade a world.
So interesting.
Where it's a coin flip up or down.
That would be so interesting.
Bro, I would love that. I don't know that we're going to get it. So I think the risk and reward, to my mind, would be once, probably getting a little long the 2-year yields here. And I'm not super confident in it. So I would do it in a way that's like risk defined and, but I don't know. I kind of like that bet right here. But man, would I love to see a world where they just pivot in Jackson Hole and they get to a neutral stance. How awesome would that be, Ilya?
I mean, that would be not that different from where they are now. It would just be a neutral stance for the worst possible reasons, where they come up and they go, listen, we've been wanting to see clarity since January, and we don't see it.
What would the market do?
Oh, they would freak out. Because they would freak out. Because I think the market has been conditioned over the past 15, 20 years that if all else fails, don't worry, the Fed is coming. You could have any which thing happen at the fiscal side. They could be in there fighting with hockey sticks. The Fed's coming. It's okay. There'll be cheap money to pay for over whatever. And if they come to the realization that the Fed is paralyzed because it doesn't know when to break the glass and pull the fire extinguisher out, that's going to be
what
a
would
recipe
real
for
estate
chaos.
do? What would commercial real estate do? God, that'd be
a recipe for chaos. I thought it was really interesting that all of a sudden nobody asked for this headline, but there was a headline today that, maybe Scott Bessent is going to be the next Fed chair after Powell. And you go, wait, did Powell resign or something? Why are we talking about this? This is not going to be a thing forever. Scott Bessent might fall out with the president next week at this speed. Like, who knows who's going to get nominated for what? But somehow these became headlines today. I don't know who went and leaked to Bloomberg, we're talking about maybe Bessent will be the next Fed chair. Why are you talking
that
about
is really
replacing the Fed
interesting.
chair?
That you have to admit, that's really interesting, because then, if you lose midterms, right, you lose the ability to maybe get a lot of your fiscal agenda done. So you put monetary policy on your side. God, what is happening?
But that's not till next year. Yeah,
I get it.
This is crazy. I think, by the way, that our disconnect on the 2-year yield is I'm looking inside of the trends of a 2-year period, and you're looking you're looking at the tail end. I'm looking at Fed funds futures out to the end of this year, and then out to the end of next year, and those specific contracts.
Me too, man.
Well, if you look,
look
at them cumulatively, them and the 2-year agree.
As I pull them up on the screen
internals
as this because it's easier for people to read. But I understand how to break down the futures contracts and term premium and everything else, bro. I do this because this is easier for people to watch.
I think the sum total of the 2-year view, as summarized in the 2-year, is one thing, but the internals of it are another.
How about I do this? I'm going to agree that I think you've forgotten a lot more than I have learned on some of these aspects. So I'm going to defer to your knowledge and expertise. So if there's somebody watching and listening and they're curious about the disagreement, I don't think I have changed my opinion, but I would say if you were going to listen to one of the two of us, I would encourage you to listen to Ilya for sure. Ilya, my friend, if I could offer you that olive branch for sure, and a deference to the respect that I have for you and all the work that you've put into this business and this industry, I would like to show you that much in good faith. Ilya Spivak, if the people want more from you, and they certainly should, tell me where they can go.
You're a gentleman and a scholar. I am at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky, mouthing off sporadically. I am always on the PM part of the Tasty Live schedule. There's this show, there's Macro Money, there's Overtime, and I'm writing for the news and insights portion of tastylive.com, where all of my various mouthing off is summarized in a pithy written form. So if you don't want to listen to me in long form, but you're curious as to what I might be saying, it's all written there in usually 500 words or less.
If you want to follow just the complete ramblings of a madman, you can follow me on Twitter. It's basically like watching somebody slowly lose their sanity. And if you want to participate on that, you can follow me at Victor Jones. The Owen Jones is 0 because I like to be difficult. And you know what? I'll say this before we get out of here. I don't know if I'm losing my mind or if I'm the same person with the same rational, reasonable, sound point of view I always have been. And just the events around me are getting crazier and crazier and crazier.
My money is on option number 2 because I feel the same way. And clearly my upside down equities exposure reflects it. I'm over here going, well, shouldn't the economy matter? And the market goes, you're out of your mind, not us.
No, bro, not in the funny money world. Not in nominal. In real terms, you might be right. In nominal terms, this thing only goes down with a liquidity problem.
That's the greatest, by the way. That's the greatest quarterly call line of all time. I'm right in real terms, but in nominal terms, our results are not quite what we wanted to see.
Who said that?
You did. Somebody should steal it immediately.
That would be brilliant.
Some
Ilya,
CEO somewhere has to take this right now.
I always enjoy our conversations more than you'll ever know, my friend. I really enjoy being able to sharpen the sword against somebody who cares about this little art form of ours, and I do think it's an art form just as much as if not more than I do. And I certainly appreciate the nuance and the way that we're able to split hairs here and ultimately shake hands at the end of the discussion. Ilya Spivak, I have so much respect for you. Thank you for coming on. I had enjoyed catching up. I'll see you back here. I think on Sunday we'll have our next discussion. For everyone else, I'll see you here tomorrow. With a discussion with Chris Vecchio. Same time, same place, same great network, only on Tasty Live. Until then, peace.
Peace.